you very much, Chair. And perhaps I might assist Mr Pike in following up on some more questioning around clean energy financing. Where do you see some of the opportunities and some of the trends in this space with the people that you are wanting to invest in this area?
I mean, look across the board, clearly in terms of the capacity that's required in terms of renewable, we have, I'd have to take on notice, I think maybe it was last year, somewhere in the order of 76 billion, but the way that number's sort of split between retail and non-retail, but we definitely have customers that we're, financing in terms of renewable capacity into areas like storage. I mean, our lending into renewable sectors is much larger. Over many years. There is, of course, a lot of liquidity, there's a lot of competition to be able to fund some of those assets. Obviously, I think that's a good thing by and large. We've been focused on trying to support our retail customers as well. We've experimented with a variety of different financing incentives. We've had support from bodies such as the CEFC to try to help customers overcome some of the capex burdens. We have an equity stake, and perhaps I'll just sort of declare that conflict in a company called Amber. I use them myself. If you can overcome the capital expenditure of solar panels and batteries, at least in my instance, with my teenage daughter's power consumption, I'm getting substantial daily savings. But you need to be able to overcome the initial capex. So I think we've tried to think about it a number of different ways, and then perhaps there's some other sectors as well that we're supporting directly who want to think and understand about their emissions and how to most appropriately manage them over time.
And what do you think is driving some of that interest in investing in these type of projects?
Well, clearly there's an enormous amount of investment that's going to be required to support Australia's energy needs. In a significant sort of compositional and transitional basis. And it's not to say that there isn't and won't be focus, obviously, on pricing, on reliability. Of course, they loom large, but I do think that over the long term, decarbonisation and moving to renewable energy will still be extremely important. I think it will be certainly a bumpy transition, and we need to be prepared to, support customers and the broader capacity and storage rollout.
And do you think the government's commitment to net zero has helped drive a lot of that investment as well?
Look, I do think over an extended period of time where there isn't, I mean, in this area and certainly in any other area I can think of, business, large and small, and capital always seeks clarity and consistency. It obviously has a big impact on their sort of return profile and expectations. So, yes, I do think a clarity around targets and policies, and not that any of those are easily set. I do think that they're important, and I'm certainly not seeking to wade into a political debate or discussion, but I think it's sort of irrefutably true that consistency and clarity are positives.
So do you think then that when there isn't consistency and clarity around the direction that the country is heading towards, that jeopardises some of those investments?
It may. I do also think that this is a very long-term transition that was always going to be uneven and challenging, particularly in the near term. I mean, I can't imagine that we won't be talking about the energy transition on a global basis, plus the consumption of energy is going to increase, I think, quite substantially. And hopefully some of the technologies that are going to be, making some productive contributions to the economy are also, we develop the capability to deliver some real breakthroughs and in some of those newer technologies. Frankly, it's going to be necessary. It's a very, very challenging task that needs to be very carefully balanced. And, I think Australia obviously has an important role to play, but also recognise that we're part of a global environment, and whilst there are some perhaps near-term shifts in sentiment, I think over the long term, I think this is still going to remain a very important and pressing issue and challenge.
Yeah, one question that I'd love to take on notice is the growth of the investments in this space and where you're seeing some of those trends in those growth. But I would like to just get some clarifying points around the 5% home deposit scheme. Is it true that those customers would, as you are assessing their applications, still be governed by the responsible lending laws?
Yes.
And I'll pick up on a point that you made, Ms McLeod, about the serviceability of these loans and the customers that you're seeing. They are, for the most part, paying off these loans?
They are, and we're seeing, in fact, the 90-day arrears as it relates to customers within these loans being slightly below the overall portfolio. So that's a very positive indication and one we keep an eye on.
So is this a fair characterisation of the cohort who are taking part in the 5% home deposit scheme, is that they are governed under quite strict lending rules, and for the most part they are meeting those loans and paying off those loans?
Yeah, I think both of those statements are true. I mean, responsible lending applies to all consumers from a residential lending perspective. Financial institutions can make a small number of serviceability exceptions. They don't have to be related to this particular cohort. I'll give you an example. We may take, as we have, a different assumption on certain sectors about what their compound income may grow at. That may allow us to slightly stretch our serviceability criteria, but these things are very carefully managed, monitored, and we report to the regulator. I say that maybe more just for clarity, but to your comments, yes, certainly at the point of origination, all of the criteria applies, and as Monique touched on, the repayment experience to date has been positive.
Yeah, great. I just want to take you, you're one of the few banking leaders who was around during the Banking Royal Commission, and you've spoken at length about the compliance that the bank has with the recommendations out of that. I think sometimes that it can become a compliance exercise, and I want to ask you what you think the spirit, the lessons, the major lessons that we ought to learn that came out of the Banking Royal Commission.
That is a good question and will require a good answer. I'll do my best. Look, I think the Royal Commission as well, it spans a number of different topics and domains. I think we've touched on some of them. The importance of clarity inside an organisation about what is your purpose, what are your goals, and I say that within what are you trying to deliver for your customers. Each of those elements needs to be carefully thought through, monitored, managed. Information needs to flow up and down within the organisation. A lot of effort goes into thinking about risks, monitoring risks, reporting on, governing them through the organisation. But also, I do think one of the most important lessons as well is the importance of ongoing and continued focus. Things tend to erode slowly and quietly versus dramatically. I think you have to always be looking for the worst examples. The averages are very sort of problematic. They can also be, things can, as I said, maybe it's related to the cultural point, sort of subtly change over time. I mean, it is dramatically different. And I can say that over a long arc of history. And that's not to say that we don't make mistakes. It's not to say that there aren't areas of I think, real frustration if we don't fulfil the commitments and the obligations that we've made. I do think it is dramatically different in terms of our ability to be able to detect those. As you would expect, there's an enormous amount of effort and enforcement from the regulator, and I say that as a positive. I think financial institutions are very complex. There are a number of sort of difficult sort of technological constraints at times. There's a lot of complexity in the business. One of the factors that comes from serving every part and aspect of Australia, we need lots of different processes. And I say this not as a criticism. We're required and we do support customers that are incarcerated. They need different processes. You need different controls. Sometimes, again, if I was looking at a financial institution, I'd sort of think, well, how could you possibly have made that mistake? And I'm not suggesting to excuse them, but certainly my own experience, having seen them up close, is that you can never be, even in the slightest bit, complacent. Of course, at the end of the day, we're there to serve our customers. We have to deliver good and appropriate outcomes for them over the long term, and of course, as I said earlier, avoid regulatory sanctions. They're very painful and damaging.
Thanks, Mr. Common. Thanks, Ms. Situ. I'll hand over to the member for Casey, and then we'll go for a break just a shade after 11 and come back at 11:15. So over to you.
Thank you, Chair. Mr. Common, just interested, how often are you personally engaging with the Treasurer and the Treasurer's office?
Whenever the need may arise, I probably...
Weekly, daily, monthly?
No, nothing like that frequency. I'm trying to think when I last spoke to him, a month or so ago. But, if there's something happening, certainly there's been times where there's been a lot of instability in markets. I may speak to him much more frequently. I certainly tend not to try to bother him with much. I think we're certainly more in regular communication with his office, but I couldn't tell you precisely how frequently.
Roughly monthly sounds like could be, depending on the situation, I understand. So I'll move on. Just want to talk about hurdles for customers to earn interest on their deposits, and just referring, the ACCC inquiry recently found that 71% of bonus interest accounts did not receive the bonus interest rate on average each month over the first 6 months of 2023. So I've got some questions. Some could be technical. If you need to take those on notice, that is fine. Does your bank offer personal savings accounts that require customers to meet hurdles to gain interest?
Yes, typically they come in the form of requiring a minimum balance growth, an increase of, in our instance, $1 on our GoalSaver product.
So just to clarify, how many hurdles do customers need to meet to gain their interest?
On that particular product, one.
But are there others are there other products with more hurdles that they would
not
need to
with
meet?
that sort of specific design. If your question is around where there's a minimum criteria, that is the product that we use in terms of the reward savings category, which I suspect is exactly what the ACCC is referring to.
Yep. And can you provide, for each of your bonus savings accounts, the percentage of customers who did not get the advertised bonus rate in each month over the last 6 months?
I can. We reported as well in an aggregate in our full year results in August. I think the number was 87 or 88% that did get it, so that will leave you with 12%. It's up substantially from the time period that you're referring to, and precisely for the reasons that you touched on. And we've put a lot of effort into alerting customers such that we can maximise the proportion of customers who are getting that bonus interest, which is obviously what's driven the increase.
And can you provide us the average interest customers actually earned on each of your bonus savings accounts and how this compares to the advertised rates?
Sure, happy to take that on notice.
Perfect. And how many of your customers do not earn interest on their deposits?
I'd have to take that precise away, but maybe it would just help if I ask a clarifying question. Are you referring to customers in savings accounts? Or
yes, so non-interest bearing retail deposits.
Non-interest bearing, okay, in transactional deposits.
Yep.
I'd have to take the specific numbers away on notice.
Yeah, and you've alluded to this in the numbers, but has your bank, and could you give a little bit of detail on what you've implemented in terms of transparency measures in response to the 2023 ACCC retail deposits inquiry?
Yes, well, specifically, which is where I'm perhaps more familiar, is in the product like GoalSaver, which my understanding is a lot of alerting both in email and I think potentially in app, but I'd need to be able to check that. But I'm sort of much more familiar in terms of what the quantum that's shifted, which I think is I certainly know it's either 86 or 87%. That are qualifying as at August, and I think from memory that's up from something like 71%, 3 years in that time frame that you're referring to in the ACCC, but I'd very happily double check those numbers.
Thank you. And do you think it should be easier for Australians to earn interest on their deposits?
Well, I think, I guess I would submit that based on those numbers, it is easy.
And do you think hurdles to earn an interest floor, perhaps pegged to the RBA cash rate, should be banned?
Sorry again?
So do you think hurdles to earn an interest floor perhaps should be banned? So do you think it's appropriate that you charge hurdles, put requirements on your customers to earn interest on their own money?
And I do, because I guess by definition we offer those accounts.
No problem. Thank you. I just want to move on to illicit tobacco. As a Victorian, it's a big issue in my community and many communities across the country, and we're seeing not just the illicit tobacco, but also the crime, fire bombings, etc., that are impacting innocent people in the community. So interested in what steps your bank is taking to ensure that it is not providing merchant services to retailers of illegal goods.
A number of steps, and this was reported recently, which you may or may not have seen just in the last couple of days. I mean, like you, this area is a real cause of concern. Maybe I'll speak specifically to illicit tobacco and clearly the growth of illicit tobacco, which, amongst other things, has been linked to crime, facilitating money laundering, and also denying the Commonwealth of billions of dollars in excise duty. So, I mean, look, we've made a decision that we're substantially going to reduce or restrict the services that we'll provide, both at a banking and a payments perspective. In the article, which is true at a substantive point, we've made the decision that strategically we're not comfortable with the risk profile. It is possible that as part of that engagement with customers and maybe some of the restrictions that we put in place, we may inadvertently identify customers that perhaps aren't engaged in that. But we obviously are creating a process where customers are able to engage with us. And I mean, if we make any decisions individually, then that would be a source of regret, and we'd be happy to apologise. But to your broader point, we've made a decision that we want to substantially reduce the banking and payment services to this sector for the reasons that you touched on.
And obviously AUSTRAC had their recent statement on illicit tobacco and cash-based laundering risks. Has AUSTRAC contacted your bank in relation to this issue since releasing its statement or prior to it?
I believe they did. I haven't personally. I think it was perhaps earlier this month, but I could double check the exact area. But I mean, similarly to one of my answers, where we have regular engagement with our regulators, including AUSTRAC at all levels of the organisation. So I've no doubt that there's a good and effective working relationship and understanding on this particular topic. There's no question that this would be a cause of concern for them, as it would be, I assume, for law enforcement.
And last one, Chair. Has your bank identified any operational concerns arising from AUSTRAC's warning about illicit tobacco cash flows? And if they have, what are those concerns?
Well, I mean, it goes to the broader point of sort of our strategic policy in terms of reducing the services that we'll provide to that sector, given the risks associated with that. I mean, for all customers, we have very clear obligations as well that we need to understand, the type of business, the purpose, where funds are coming from. There's a whole range of different sort of obligations. So, I mean, I certainly wouldn't link it to this. Sometimes we have to do that on an individual basis, individual customers, understand their source of wealth, turnover, identify any suspicious matters, and we have to promptly report those to AUSTRAC. And occasionally we look at whole sectors, and we think that the risk profile associated with that makes it very difficult, if not impossible, for us to provide banking services to them, and so we seek to cease doing so.
Perfect. Thank you, Mr. Coleman. All good.
Okay, so we'll adjourn for a quick break until 11:15. And we'll see you back at that point in time. Thank you. Now hand over to the member for Moreton.
Thank you very much, Chair. Good. Thank you, Chair, and thank you very much for coming to give evidence today. I was going to focus on home loan offset accounts and was going to ask in the first instance, are you aware of ASIC's concerns surrounding potential issues with the operation of offset accounts not functioning as intended, as referenced in their strategic plan?
Yes, broadly, I think so.
Yes. And when you became aware of that issue, did the Commonwealth Bank take any steps to investigate whether indeed your own offset accounts had been functioning properly?
Look, I'd need to double check, but it's an area that we have reviewed in the past. I'd have to check the periodic or the frequency of those reviews. And look, I think it's reasonable for ASIC to be focused on it. There can sometimes be some complexity with the establishment of that, so perhaps I could take that on notice.
No, happy for you to take that on notice. And I was going to ask, in those previous periodic reviews, were any other issues uncovered with respect to those offset accounts in the past?
I mean, I'd have to double check some of the specifics. I mean, the offset account is generally making sure that the account is set up as instructed by the customer. Sometimes there can be multiple accounts, multiple offsets, some of the linking between those accounts. It would be issues of that nature. But I'd have to double check to be more specific.
No, I understand. I was going to ask, who do you think the onus should be on in terms of detecting any errors of that nature?
I think it's incumbent on financial institutions to review that and where mistakes are made to remediate them. I wouldn't necessarily want to imply that would be in a real-time basis, but I mean these are reasons why we have control tests and reviews and sometimes audits of different areas, and unfortunately from time to time they do identify that there have been some operational errors. Sometimes they're very easily picked up. Obviously we invest in what are known as preventative controls, basically ways of preventing mistakes from being made, but it's also important for financial institutions to have means to be able to detect those variations, and if there's some benefit hasn't been provided to the customer that they're contractually entitled to, then it should be promptly, and to the extent that there's been any period of time where that benefit hasn't been applied, then it would be applied, and we have a formula to calculate the interest payment over and above the dollars that are outstanding, which is I think it's a referable rate to the cash rate plus some form of penalty interest.
Thank you. I might just move on to AI. Can you take the committee through where you've deployed AI across your bank and what functions?
Yes. Perhaps AI in the context of perhaps more traditional techniques, including machine learning for more than a decade. Machine learning being more advanced analytical techniques that effectively make predictions. We use that in, probably the most well-known would be in the mobile banking app. We provide personalisation and experiences within the app. We would be making certainly tens of millions of decisions every day based on billions of data points. We use at least some of those techniques, which would be known as AI, or under a family of AI and machine learning in areas like credit decisioning. More specifically, I think obviously there's a lot of interest in generative AI based on large language models that use a particular technique around neural networks. We are using that in the digital experience. We're trying to build out the ability for customers to be able to ask broader questions, to be able to interact. We would like to be able to, more specifically in areas like fraud and scams. We are working on a variety of different both internal use cases, so helping staff members in terms of what's known normally as like some form of knowledge or retrieval, or RAG technology, which basically retrieving policies, procedures, helping our people get answers. We've rolled out capability and tools to just about all of our employees. There's some restrictions. There's a number of other use cases that we are working on as well, and a number of use cases which are going to be really important to be able to protect our customers from what we see as increasing sophistication, which I'm happy to talk to in some detail, and sort of areas around scams and fraud and cyber in particular.
And understanding that you've been working to use AI to increase or improve scam fraud detection, but also to change the customer experience. Have you implemented the use of AI to reduce costs for customers?
We've implemented AI across a range of use cases. Some of the benefits of that, and I think it's really important that the benefits that we're seeking to deliver are not certainly solely weighted towards costs. I mean, our primary benefit that we're seeking is improving customer experience, but there will be some instances, and there have been to date, where there is some cost savings that are available to us. I'd say overall they're relatively modest at this point, and this is an area that we're giving a lot of thought to in terms of the appropriate deployment and how to manage, as I said, the benefits that we deliver to customers, not just related to cost reduction.
And where is consumer data processed or stored for those AI systems?
Well, there's obviously a lot of data that we hold on a lot of systems, but if I simplify it down to, we have what we call a relationship. We have a single system that manages a customer view and most of the interactions that our team have with our customers. That's known as ComSI. We have a core banking system that obviously has its own database. There are a number of different sort of data stores that hold different parts of information about different customers. We obviously have to do a lot to keep that data both protected and to a high quality.
And are there any specific safeguards for data that is used in AI specifically that have been developed for obviously the increased use of AI?
Many. Yeah. I mean, if I to the extent that it's helpful, we have a lot of processes, frameworks, policies around governing the use of AI, as we would for any model. It doesn't need to be an AI model. It can be a more sort of statistical or regression-based model. There are verification, validation. There are particularly things such as guardrails which protect against use and misuse. There are very clear responsible guidelines which we've published. We seek to monitor the performance of those models. Of course, we're very conscious about the information that we're using, whether customers are given their appropriate consent, how that information is used, how that may result in inappropriate outcomes. All of those areas are modelled and understood and monitored closely.
I'm interested in the impacts on workforce in this space. We've seen some reports about people's jobs being impacted by the presence of AI chatbots. So can you please take us through what tasks are being automated and how you're managing those workforce impacts?
That's the last question.
Yeah, I mean, look, there'd be categories of tasks. I do think maybe a couple of things. One, I think the impact on individual, the totality of employees at this stage is small. I do think it's perfectly understandable that there is, some degree of trepidation and concern about how AI may influence and impact tasks, skills, what new skills will be required. This is a very important area of focus and something we've been communicating a lot with internally. It's hard for me to give you a generic answer because, my general expectation is that at least a subset of tasks that just about all of us do over time should be at least augmented by AI. I think actually the commercial pressures that I touched on earlier, I think they'll be felt more acutely, not through an AI lens per se in the near term. I think, over time, though, there certainly is the possibility that that's going to, the probability that that's going to have direct workforce impacts. We're spending a lot of time trying to think through how the workforce may change over time, acknowledging we certainly don't have all of the answers, and there's also tremendous uncertainty. But this is an area that, we've certainly given quite a bit of thought to, and want to make sure that we're engaging appropriately, not just inside the organisation but also externally. It's clearly an area that there is enormous public interest.
Thank you. I'll hand over now to the member for Deakin.
Thank you very much, Chair. I was wondering if I could revisit that $270 million or $280 million figure raised before. As I understand it, these were fees paid by a low-income cohort in connection with high-fee accounts, which they didn't need to be on because they were eligible for low-fee accounts as well. Your earlier answer referred to goodwill payments rather than remediation. Is the bank's position that it complied with its obligations under the banking code to those low-income customers?
Yes, it is. And I guess, I'd make the distinction that I think it's perhaps more of a generalisation to say all of those customers are by definition low income. I don't think there certainly are low income customers that are concession customers, but definitively not all of them. Those fees were charged, as I said, in accordance with the terms and conditions. It's not to say because
if I could interrupt, these are the terms and conditions of the high fee account that they're placed on. The question really goes to, were they informed of their right to go onto a low fee account? Well,
as your question touches on, there are a variety of different accounts. The more basic low fee or zero fee account is available to customers. Obviously, it has perhaps more restrictions or certainly less features.
Was the availability duly disclosed to those cohorts that you were required to disclose it to under the code?
Well, I believe it was disclosed. We may have differing views about the adequacy of that disclosure, and to be candid, I'd have to take on notice exactly what steps were taken beyond sort of broad generalities.
So would it be fair to suggest that in cases where it was found that the bank had not fully disclosed as required by the banking code, and that a person found themselves in a higher fee account and therefore incurred higher fees, that they would be entitled to remission?
I think there's a number of sort of leaps in the premise of that question, which I
feel free to fill them.
I wouldn't be prepared to accept. I mean, I do think it's reasonable, and this is also a topic that I know is in for consultation with the ACCC about whether the specificity and the level of efforts that are taken to migrate customers, and there's certainly a preference from some stakeholders to automatically move customers from one account to another. There's a spectrum here of perhaps, and I think individual preferences would differ. Some people would find it, they certainly wouldn't appreciate being moved from one account to the other. Even I think in circumstances where perhaps there may be lower fees, I don't doubt that there may be improvements that we could make to the information, the way we engage with customers. As I touched on earlier in answers around the reward saver, I think there's good examples where we've done that. So I'd acknowledge that there may be areas for improvement, but I wouldn't accept some stepping stone liability equation.
So the premise that losses incurred as a result of the bank not complying fully with its obligations under the banking code, if such a loss were to have incurred, would that...
I'm not sure. I wouldn't agree with the characterisation of it as a loss, nor would I agree with it as excessive.
So paying fees that they would not have been required to pay had they been fully informed is not a loss?
There's a lot of ifs in that statement.
Well, let's say hypothetically they were incurred and would not have been incurred had they been placed on a low fee account. That's not that much of a leap, is it?
Oh,
there would be some in that cohort, even if you don't accept that everyone's a low-income earner, and that some wouldn't have chosen to be on a high fee account. That there would be some, at least in that cohort, who were placed in an inappropriate account and incurred avoidable fees as a result of a lack of disclosure of their options.
But I think you will find, at least my view would be, that will hinge on what steps were taken, whether they were appropriate. I don't think the obligation is going to be to ensure that we forcefully migrate every customer into that, and therefore there's a consequential loss from that. I mean, imagine the implications of that across all parts of the economy.
So my question
you're assuming no agency or involvement in that decision making.
I think this is about agency and being fully informed at that initial instance, that these are your account options. As a low income person, you're eligible to be on this low fee account, and that will mean you incur lower fees.
Sure.
The migration's a kind of separate question.
Well, but I believe that steps were taken to make those options available to customers. As I said, we may agree or disagree whether those steps were appropriate or not. I think then the leap to imply that somehow those fees were either unlawful and deserve remediation, I just don't think is correct. But as I said earlier, it's not that we are not contemplating, because we are. What do we think the appropriate rectification is? But I do think it's a very, putting on the side the specifics, a very challenging precedent to then say if something was actually operated the way it was designed, but now you want to go back and retroactively change things. I don't know that that's a particularly strong foundation.
So would there be a process, and I don't know if it's been developed yet, for the bank to review whether someone has, whether the bank was, discharging its obligations in full on a case-by-case basis, understanding that, every interaction is its own, for that to be revisited in a simple enough process for people to have their case looked at?
Yeah, look, there's certainly a lot of steps taken and changes that we've made on a go-forward basis, and I think that's a much easier, equation to both comprehend and contemplate. I think, as you would appreciate, with millions of customers over, I think the time period was 2019, it would be very difficult to determine exactly, of course, what offers or where the information was made available, but how people engage in that information would be challenging, I think, to establish.
So you were saying going forward, so you haven't got a program for revisiting that kind of cohort of customers there?
Well, I do, insofar as the customer cohort that we're talking to, that you're referring to try to find an appropriate, as I said, goodwill payment, which I think strikes the right and appropriate balance. But I also accept that reasonable minds may differ about whether the judgment that we form there is something that is entirely consistent in this instance with how you may view it.
So when will we know the kind of full scope of that program?
Well, I certainly would think that will be in the coming months, and I'm confident by the time our next appearance, I'm certainly happy to provide some update if that would be helpful to either the chair or yourself.
It certainly would be, thank you. I'm just going to switch topics around because I realise we have limited time.
I don't mean to interrupt. Just very quickly, and I'll make allocation of time. Mr. Common, with the greatest regard, I think this is a sticking point. I think that there are going to be differences of opinion about how CBA is managing this. This is a low-income cohort. You can take on notice and let us know the percentage, but I just think if there's the question about agency that's been raised in the back and forth here that I think is worth following up. I take on board your point about forcible movement of people, but giving them the option to go for a lower fee account and for them to save money. And if they've been on a higher account, ASIC has taken a different view to your organisation about how to manage it. I'm just saying, I think I'll take on board your point about reasonable people. I think reasonable people would see that that this is a sticking point that I think would be good for revisiting, and we'll be very keen to hear how CBA is managing it, if I can put it.
Yeah, no, I'm entirely comfortable with that and happy to do so. I guess, I make a number of sort of comparisons. Would you make the same comment if someone was, paying a higher interest rate on their loan or their deposit than someone else, if there was a better offer that was alternative to them? I think the distinction that I'm seeking to make is that there's a difference between conduct that's in accordance with the terms and conditions versus conduct that is not, where there are clear obligations and breaches, and we're moving from sort of contractual obligations into well and above and beyond that, which I do say is appropriate in some circumstances. I don't think by definition it's therefore appropriate in all circumstances, but I'm happy to provide an update and accept it there.
And when you say terms and conditions, do you include the bank's obligations under the Banking Code post-2019?
Yes, I do.
Cool. Could you give the committee an update on how what your bank is doing to support banking in regional communities at this point?
In what regard specifically?
So I know there's discussions between banks as to how we can ensure the longevity of access to regional branches. So an update on the work being done in that space.
Yes, well, we announced, I'm trying to remember when, but some time ago that our branch moratorium would extend. It was initially until the end of 2026, and then we extended it to 2027. So I think sort of clarity and consistency in terms of regional footprint. We also offer access through Australia Post or Bank at Post. We've recently, I think it's a matter of public record, perhaps not the specifics, but renegotiated and offered to provide additional payments to them. We, amongst a consortium, have voluntarily increased the payments that we were making to the cash utility that, the cash services provider. And so I think there's certainly clarity and consistency over those services. Regional Australia, of course, is very important to us. We have by far the largest physical footprint in terms of branches in regional Australia.
And in addition to that, we've obviously looked to extend services where we can by using multi-channel branch time in regional areas to actually utilise that half the day through branches, half the day through call centre. We also look to roll out programs such as the First Nations Reach program, whereby we go to remote communities. So we've actually built that program, and we visit 33 remote communities, go in for 2.5 days, really try and help with banking and education as well. So there's a number of other things we have in train beyond just the network itself.
So, I mean, the moratorium is presumably a stopgap option. Have we looked at kind of business delivery models post-moratorium, whenever that might end? What is the future? Is it, a bank branch acting as an agency? Is it an industry levy that incentivises any bank having regional bank, branches? Are there kind of longer-term models that are being explored among the industry?
Yeah, I think that they're important questions. I perhaps need to be somewhat mindful that despite media reporting, and others are under sort of NDA as it relates to some aspects of that, but perhaps we'll sort of make a broad generalisation. I think you could even conclude from those that I'm sort of broadly supportive of something that would require financial institutions, large and small, to at least make a modest contribution, and any reasonable expectation we would have that we would be making the most significant. But this goes back to this point around the way the market is reshaping, and we may have differing views about. There's a lot of focus and intensity on competition in and around wealthy urban customers. It is expensive and hard to service regional Australia. It is also critical, and so getting some appropriate commercial balance we think is important. There's a number of different ways that could be done. Certainly, we have the intention and wish to provide those services well into the future.
Okay, one quick question from Mr. Violi and then over to Ms. Jarrett.
I thank Ms. Jarrett for indulgence. Just on that regional banks questions from the member for Deakin, following up, I know Westpac announced that they were going to extend their moratorium from 2027 to 2030. They announced that this week. Is that something Commonwealth Bank is now actively considering as well?
It's something that we're regularly thinking about. It's not something I'm going to give any, specific conclusion to at this point in time. As I said, the moratorium already extends into 2027. I think we've got 281 regional branches. I think that's approximately 54% more than Westpac does. I mean, obviously, any institution's free to make whatever decisions they would seek to. We certainly intend to have, a significant presence in regional Australia and support all parts of the country, and that's will continue to be our focus.
Thank you. The award for greatest indulgence goes to the member for Brisbane for indulging the extra time. You've got 10 minutes. Starts now. Over to you, my friend.
Thank you, and thanks for your evidence today. I'm going to cover off on scams and a couple of other things, but let's start with scams. We've got the National Anti-Scam Centre saying there's approximately $2 billion in losses affecting almost 500,000 people. The government's spending hundreds of millions of dollars to fight scams. You've said that you are spending yourselves $1 billion on financial security. I'm interested to know how much of that is going into anti-scam prevention, but also are you seeing any trends that we should be aware of in terms of how this challenge is progressing?
Yeah, thank you. I mean, the number that's reported is, of course, difficult to estimate. It's, substantially larger than the number that we would see, but there's questions of underreporting. I do think, and this has been covered, there has been a lot of progress made across the industry, at least as I said, from what we saw at the peak, I think, which was 2022, where it's down something like 76%. the $1 billion that I mentioned a few times, that's across what we would categorise as economic crime, which is financial crime, scams, fraud, cyber. The reason as well is there's a number of protections that we're working on at any point in time that serve multiple purposes. So, I mean, I'd be happy to detail all of the things that we've done to reduce scams by that point. We're very supportive of the scams protection framework. We're supportive of the higher obligations on the banking industry. Of course, we'd like to see those applied equally across other industries. They will come with, I think, protections as well as obligations that will enable greater information sharing to be provided across the ecosystem that I think will continue to reduce. Specifically to your question, maybe a couple of particular, so that scams obviously broad range of different categories or subcategories. Happy to talk to as many of those as would be helpful. Two that we're perhaps focused on where we've seen pressure is in what's known as a business email compromise, whereas maybe the business is sort of via a cyber attack gets access to their information infrastructure, may seek to, amongst other things, modify their bank details that they're putting on their invoices, and so a business customer may unwittingly send that to one of their customers. The customer makes that payment. Of course, we're obliged to make that payment on behalf of the customer. That's where things like confirmation of payee are so important. And then the second area where there's real growth, which perhaps supports my earlier point around ecosystems, is an increase in buying and selling scams on marketplaces in particular. That's often where someone's purchasing, or they think they're purchasing something, but they're in effect purchasing nothing, or via a scam. And so these are very difficult for us to predict in ahead of time, but as an example, that's an area that, post the implementation, and there's a lot of work that needs to be done between these codes, information that would show that, let's say, Monique was subject to one of those scams, which I'm not suggesting you were, and then we'd have obligations to respond to that. So if there were particular bank details, we'd have to be able to prevent payments. That there has to be a way that we're able to work collectively across the seams of the economy to continue to reduce scam losses. It's a very high priority for us. To your question about how much specifically in scams, I'll probably get into difficulties around splitting which is which, but I'm confident it's above $100 million.
And it's good to hear that the scam prevention framework is being perceived, I guess, positively. How are you going in terms of implementing it, or getting ready to implement is probably a better way to say it?
I think it certainly needs a lot of focus. I think the former member, Stephen Jones, who took that through, I think it is genuinely a leading piece of global legislation. The understanding, or certainly the expectation, was that we would do everything we can to support that. The overarching legislation is created. What needs to happen and is underway, and obviously Treasury are drafting, is these industry codes need to intersect. There'll be some other elements that will need to be updated, things like the e-payments code, which didn't specifically contemplate some of the details within scams. ASIC's got some work to do there, and I'm sure they're well across. Obviously, the ACCC plays a role in that. Then we've got to get clear on liability. How's that going to work? We've got to make it simple enough for customers to be able to navigate, because consumer groups quite rightly would have an expectation that I've got a front door or as few doors as I need to engage with. Imagine the tedious nature of trying to work out whether it was where you go within Meta. There might be multiple financial institutions. Yeah. So there's a lot of really important detail. I think, speaking to a member of my team that's leading all of this work, I think and hope we're getting close from a bank perspective. This is a key topic at the next ABA meeting in a couple of weeks, hopefully, to get as much alignment as we possibly can. And then, of course, we need the support and encouragement. I think it's fair to say that the tech sector will be reluctant participants. I don't think that's too much of a stretch, perhaps not all equally. So they may need more than encouragement. But I do think if implemented, notwithstanding, there will come costs to us. This is a much better system. This is going to deliver real benefits to Australians. And one thing is evidently clear over the last few years: organised crime do not have a productivity or an innovation problem.
Yeah.
And I would just add the one other piece is the actionable scams intelligence sharing and real SLAs around that, because what we can see through lots of different examples or case studies is where we have been able to share that when we can act really swiftly is when that's two ways. We need everybody at the table at the start, because that's the way that will make a real difference.
That ecosystem approach is very important.
Absolutely.
I think. Yeah. If I could just switch gears, Chair, I just want to go back to the fees and charges on low income customers, and noting also that the CBA really has a real focus on customer service and looking after its customers. And I appreciate that you're challenging the 270 or 285, and to the extent that some of that is overcharging, some of it may not be. But I think you also sort of said some of that has obviously been done within the terms and conditions at the time. But given CBA has a licence, social licence to operate, and you mentioned that yourself, Mr. Comyn, at the start. How do you reconcile that, right? How do you reconcile charging, knowing that you're overcharging customers or have? You're prepared to do some goodwill payments at this point, but I can tell you there's a lot of people in my electorate on JobSeeker and other allowances that would have been hit by this.
Yeah, look, I think perhaps maybe what I'd say, without going back down, because I'm not sure I have a lot more to add on the specifics, but maybe we go up more broadly. We are acutely aware and focused on our social licence. We, as I said, have a breadth and depth of services that we provide to customers. One aspect of this as well is we have to both, contemplate, and we already do, not only our obligations, but also like generalised expectations over and above those. I would at least categorise this as a level above that. Then I would sort of look to, there needs to be sort of the sustainability of being able to provide those services, and perhaps I'll sort of return to that. And this is an overarching element, and I know this can easily be misinterpreted as the banker sitting here. We don't seek to maximise returns. We seek to earn a reasonable and sustainable rate of return. What worries me is in a market structure, and look, I'm linking a few topics and I could deal with them in isolation, but this is still equally valid and I think important strategically for the committee to understand, where the commercial pressures are great around heavy competition for affluent customers, a whole range of institutions that seek to not only provide no service to any of these customers, make no contribution. That's fine. That is our issue that we need to be able to deal with. We need to have some sustainability of services, because in an industry where an ever-increasing proportion of customers to serve those customers, the costs cannot be recovered. I've not seen an industry anywhere in the world where on an ongoing basis that doesn't lead to a loss of accessibility or a degradation of service. And this is, is quite interesting, and perhaps I'll use one sort of example, which I think's hopefully relevant. It's also substantially my fault, so I think it's a reasonably valid case study. In 2017, we removed ATM fees that you pay on other financial institutions. I thought that was a good idea. I don't think it was such a good idea now looking back. Why? Well, mortgage profitability was more than 2x what it is today. There are a whole range of other fees that we've eventually been pressured into, which is fine, reducing. Now, ultimately, what's happened, which we didn't contemplate at the time, financial institutions have sought to, at scale, offload their ATM networks. Why? Because there's no commercial model around that. Who charges the fees? Third-party fees, third-party companies that are not subjected to the same social licence obligations. I'm not even suggesting they should be. So I've sort of defrayed and moved one cost to another. It's just an example of this sort of like pernicious slope, and it's the slippery slope that we're seeking to avoid. We're trying to come at this issue with a set of principles. I think we probably broadly align with those set of principles, but we may, I suspect, not entirely align with the application of those principles. And I'm simply seeking to underscore we're trying to strike the right balance between what we think is appropriate, fair, consistent with all of those, and consistent with our broader obligations, or certainly my obligations to the owners.
I understand what you're saying. I understand.
Yeah, I'm using shareholders and owners interchangeably in that context, but yes.
Yeah, I understand that you're a business, but what we're really talking about here at basic tin tax is overcharging and compensating low-income earners who are overcharged, and noting that CBA is taking a different approach than your competitors.
Yeah, I won't waste the time by sort of refuting a number of the descriptors there, because I don't think that's the case. And yes, we are taking a different approach, as I think we took a different and more generous approach to the Indigenous customer cohort. Yes, we've at this stage taken a different approach to the other institutions that are in there. The scale, breadth and reach of the services that we provide is unmatched. But again, obviously institutions can make their own decisions. We're attempting to strike the right balance. I certainly register and acknowledge the questions that I've received on this topic, and I'll be happy to provide an update.
Thank you. Thanks for that. Going back to AI, I've got 5 minutes of questions and then the Deputy Chair I'll hand over. Some I'll take on notice in terms of how much you're investing AI, I'd like you to take on notice, I should say, how much you're investing in AI and growth-focused tech and in what areas. But I would like to ask quickly 3 questions in a general term. How you disclose AI use to your customers, including when they're interacting with AI agents or when AI influences decisions. As the MD, you've said, and I do respect the fact that you've really lent in terms of the application of tech in your institution, but you've said CBA will continue to keep humans in the loop as you deploy AI, so I'd be keen to know what that looks like in practice. And finally, you referenced today credit decisioning as an area where you use AI. So how do you test for discrimination bias in automated decision making, especially for low income or vulnerable customers? So those 3 questions about disclosure, humans in the loop and discrimination bias.
Certainly, let's start with the last one. How we manage around a whole range of different sort of biases, or we say unintended negative effects, happy to provide detail on that. There's some comprehensive processes around that. Yes, broadly to humans in the loop. I mean, we've also had some observations about that as well, insofar as depending on the quality of the model, even having the human in the loop, people over time perhaps don't have the same sort of rigour. It's different, but analogous. That, you know, if I was self-driving for 10 years and my car required me to take over in an emergency, I dare say my skills may have eroded. So we've got to try and strike the right balance. There's a lot of interesting learning for us. Broadly, what I would say to influencing, where we use statistic, and this is a spectrum of where what could be known as AI, but I've sort of certainly put machine learning underneath that. We basically cover that in the context of our terms and conditions on individual products. Obviously, there are restrictions to how we could use that data. I can't recall specifically what the terms, but there are tests against the privacy obligations, but I'm sure there's a reasonableness test. At least where a customer is interacting with AI, we have all sorts of different, and this is a very small aspect of what we're doing today, but I think an important one going forward. We tell the customer, we give them the option to opt into that process. I think more than 2/3 of customers are now sort of opting into that process. This is really an important area, which I'm sure is behind your question, Chair. There is enormous capability with these models. The ability to perhaps what is known as hallucinate is sometimes misunderstood. It's more of a feature, not a bug. It's very hard to entirely control for that, but it's also extremely capable of providing high quality information. We're trying to work out how to intersect between the expectations we would have in ourselves, how I think the law will apply, how those obligations will be perhaps enforced on others that would currently be sort of outside of the regulatory net. I think these are going to be important things to be tested in the coming years. But I mean, there's certainly parts of our service model that we can identify that would augment and improve the customer experience, and if we can do that safely and reliably, then we'd seek to do so, and we expect and anticipate, as we should, to be subjected to a great deal of scrutiny, and we'd be happy to respond to any questions in that area.
Thank you. Thinking about the fact that you've moved your your core banking system into data centres managed by AWS. I was contemplating that as you were answering the questions to the member for Moreton around onshoring and offshoring of data. The other way to rephrase that question is, what are the expectations that CBA places on, say, AWS about where the data is stored?
I mean, a range of obligations specifically in that area. Onshore, they have multiple domestic data centres, which are effectively part of a cloud-based operation. Most of I think all of the significant players in Australia have data centres that are effectively all onshore.
Right.
We have very strict restrictions about what sort of data would be permissible at all on an offshore basis.
And I notice people are keeping tabs on how rising technology and cloud service costs are feeding into your cost base. How are you tracking that risk?
Mm-hmm. Yes.
How are you tracking it?
By seeing it in the P&L every month. It's up substantially. There's clearly a trade-off. Often your costs actually of compute and storage go up. And so it's sometimes misunderstood. You're generally paying more money to be in a cloud environment. Maybe it's going to depend on your workloads, but what you're getting is a greater sort of resilience and capability and security and monitoring that's very difficult to replicate. I mean, we still have some what's known as on-premise applications that run in our own data centres, but they are running over AWS or, frankly, some of the other cloud providers. I mean, 6, 8 sometimes data centres. They're just at a level of sort of scale and capability, but it's not to say that they can't, as recent events have demonstrated, ever have any instances. So, look, we expect to provide still some on-premise data workloads. There are advantages, at least in the near term. They're not necessarily financially driven to move into the cloud, but there's a number of other technical capabilities that you can take advantage of when you're in that environment. Yeah.
I've got some questions on the strategic partnership with OpenAI, but I'm going to put those on notice if I may.
Sure.
The last one I did want to ask, look, just within this room, I have a complicated relationship with chatbots. I'm not a fan, so I'm just confessing that to you, if you don't mind. But I think Agentic AI offers something... What's that, sorry?
They don't like you either.
I can tell by the way they deal with me. Agentic AI, though, there's a lot of focus on how that'll help guide customer experiences and customer applications. How do you see that? Is the Commonwealth Bank contemplating the role of Agentic AI in its customer offering?
Yes, we are.
How are you? Is there anything that you see where this will play a particular benefit for customers? And that's my last question.
Well, I mean, I think effectively, what does Agentic AI provide? Well, I mean, the models provide intelligence. What Agentic, or what's broadly referred to as Agentic, enables you for those individual agents to have access to that intelligence, to have access to tools that can come in lots of different, and it enables you to sequence or manage or orchestrate work. It's very early days, but are we experimenting with those technologies? Do we see? And you can go from a very simple agentic use case, you can go to a more complex, anything that's longer running, anything that requires more comprehensive orchestration is by definition going to be more challenging. The technology is still nascent. I mean, I think this will be clearly an area of focus over the next couple of years, and it would rely on the trajectory of model improvements, continuing at a very rapid rate before you could, I think, undertake very, very high sort of accuracy workloads. But we're definitely experimenting with these technologies in a number of different ways, including some of the really challenging areas, including economic crime that I touched on.
Okay. And I've also got some questions on notice the Scam Victims Alliance has raised with me, so I'll put those on notice if I may. Over to the Deputy
Thank you,
Chair.
Just to touch on energy again, I think one of the previous members talked about whether it's a structural driver of inflation. Does your research team look at energy forecasts as part of their inflation forecasting work or economic?
We certainly have a team within our economics department which does work in and around the energy sector. They certainly, and that comes in a variety of different forms. I don't know specifically, and some part of that would be thinking about things like capacity and pricing. I don't know how specifically that then sort of traces into the model that's predicting inflation. I'd be sort of happy to take that on notice. It's certainly not an enormous leap to think that they would contemplate that.
Yeah. Do you know if that team has predicted in any of their scenarios energy prices coming down?
I'd have to take that on notice.
Yeah, if you could, that would be great. Maybe moving, you touched on crypto and earlier. 25% of Australians own cryptocurrency. What are you doing with regards to them making deposits and transactions and enabling that or otherwise with CBA?
And when you say enabling that, insofar as permitting customers to transfer into crypto?
Permitting or not permitting, either.
Yeah, well, we permit it, but we have made restrictions to the velocity and the quantum that customers are able to transfer into crypto. I think at times that can no doubt cause some frustration for individual customers, but this has dramatically reduced some of the scam losses. So we think about certain like fraud density across individual providers. Obviously, there's some very reputable, perhaps some that are perhaps less sort of reputable. There's interest from an investment perspective, as you've touched on. I mean, globally, there's been some pretty significant shifts in, I think, an adjacent area that you're well aware of in terms of stablecoin and sort of tokenisation. We're doing work with the Reserve Bank, amongst others in that particular area. We're certainly not planning on launching anything in the near term around retail, but this is an area of both strategic and customer interest.
Yep. And just Treasury's got laws at the moment out for comment to sort of regulate crypto firms with AFSLs and others. As they roll out, do you see tiering how you deal with these firms differently, and are you tiering them now where reputable, regulated firms are subject to very different regulations to those who are not?
We do have some tiering. I think from memory, I think we've made contributions to that sort of consultation process. I do think in and around, there's a couple of different dimensions to that, but having clear regulatory requirements, obligations that will give customers increased confidence in the reliability of those individual participants, that may be through sort of AFSLs, obviously aspects of the Corporations Act, like efficiently, honestly, fairly applying to those providers. I think providing that regulatory certainty and capability will be good for the industry broadly defined.
Yep. And two very quick questions. One, given there's about 15 billion in crypto platforms, I'm told a lot of those platforms are struggling to bank with different Australian providers, and they're being funneled into maybe one or two banks in all of Australia, very small banks. Do you have any views on the risk of this to the Australian market and system, in that larger banks are not banking these platforms at all?
My information may be slightly out of date. It's been some time since I've looked at that. I don't think it's the case, obviously, in its entirety. I'm certain there would be different risk factors. I'd be happy to sort of look into specifically, what our policies are. I've no doubt that we would be supporting some of those, but there no doubt will be some restrictions from a risk appetite perspective on our behalf.
My information is that the Big Four aren't. Maybe that's wrong, so maybe you can come back to us on notice with that. I just worry about it from a global, an Australia-wide risk perspective for the banking system. And then the last question, stable coins. Also, some of those providers are being banked and are not being banked. Any concerns you have about how banks could play a role in actually picking winners in that way, or investing in picking winners? How should we, as policymakers, be thinking about that so we're actually having a market that works for this?
Yeah, no, and I wouldn't say that we are trying to pick winners. We may be having a view around sort of risk appetite. And stablecoins is clearly, I think the numbers are something like 300 billion on a global basis, up 60% since the change in the US administration. I think that there are particular use cases. So stablecoins are often to support emerging markets who want to have access to the US dollar peg. That can also be on and off ramps for decentralised finance. So, I mean, I don't think we're seeing the same sort of scale of demand in Australia, but I do think it's an important area. Inevitably, there'll be growth in volume. I'd be happy to look at some of the specifics in terms of what we currently will and won't support. I suspect some elements of that will be judgmental, but I do think this sector will continue to mature. I think regulatory clarity and consistency, no doubt will be a positive for lifting standards and confidence across the sector.
So if you just take that on notice, maybe with the blockchain one, on how you're actually banking the sector and how you're playing consistent policies across all of those. Thank you.
Thank you. Member for Brisbane, and then we'll go to the member for Deakin.
Thank you. Just moving on to operations, actually. I understand that the net profit of the bank in this last fiscal year was about $10 billion. Am I right with that?
Yes.
Great. And that's significantly bigger than the other banks, so well done. But obviously profits do get distributed to shareholders, but how much are workers actually benefiting, your workforce benefiting from the increased profitability of the bank? I don't know if you can give an average salary increase, executive, non-executive. If not, I would actually be interested on notice, question on notice, Chair, as to what the salary increases might be at executive, senior manager, analyst, whatever the main levels are that you structure your remuneration around. So that's one question.
I'm happy. There's a variety of different ways we could categorise that. I'm sure we can provide an appropriate detail. The only thing I would add to your question is, yes, we make a larger profit than the other financial institutions. We're also substantially larger. Yes. We've got a $1.3 trillion balance sheet. If we weren't earning a larger profit, there'd be a problem.
Fair. The other question is gender pay gap. Across the banks, it's about 24%. Can you give me an indication what it might be at your bank? And I'd also like to understand what you think, at least looking at your own shop, what the drivers of that are and what more can be done to close that gap.
Yeah, on the specifics, it's in that order for us. I would have said in the mid-20s, but I'd have to double-check that for you. I think we've made some improvements in the last reporting period. I think, from memory, a couple of percentage points improvement. I would acknowledge that there is certainly more work to do. I think there's a variety of different initiatives, and we were going through this recently, and what are we tracking it, understanding it. Clearly, there's some sort of compositional areas where we're weaker. Some of our more entry-level roles and branch network tend to be have more female participation. We're trying to sort of counter that in some specific areas. There's also in technology actually made some significant improvements in terms of gender balance and at more senior levels. I don't know that, at least from what we've seen, there's a singular factor, but it's certainly something that we need to continue to make progress on an ongoing basis and be able to narrow that from where it is today.
And are you seeing, just an extension of that, are you seeing a movement of women out of your ranks, going from that sort of manager to senior manager level? And have you got really targeted programs there? Because I'm hearing that not just your business but across the corporate sector, that's a bit of an issue.
Look, I think it's important with a target, particularly at an aggregate level. You'd need to de-aggregate it, and so we do at an individual. Certainly for my direct reports, obviously I have an important role to play there, and then there's specific areas. I mean, in marketing and corporate affairs, that would be a much more balanced. I can't remember what your specific gap is, but let's say technology, that would have been a larger gap. We've actually increased at senior levels. Quite substantially, which is a positive area. So it tends to be in those areas where perhaps we just haven't made as much progress in focusing on there. And I think, like any sort of target or goal, breaking that down and setting an expectation and tracking that is important.
And then when you think about specific programs, we do have internal programs set up where we are trying to encourage and make sure that we're keeping women at those levels. So I, for example, host an internal network called We Can, which is about gender diversity. So we're making sure we're driving connection. We also a member of Chief Executive Women. We've very recently, in fact, in the last 2 weeks, we run an alumni program. We run people through the courses there to make sure that we can actually try to, really kind of keep women rising through the ranks. So I feel like there are a number of different programs that we have in place. But to Matt's point, it really does vary by the different areas we have. We support, women in tech through the Vogue Women Codes program. So it's tailored, but certainly with the intention of making sure that we're continuing to improve.
And you have clear targets, gender targets in those. Okay, thank you.
Good. Okay, over to the member for Deakin.
Do you have a net zero policy, and why is having a net zero policy important to your business and your customers?
We have a variety of policies, and specifically in and around climate and sustainability. One of the reasons why we do is so that we try to communicate clearly about what our goals and targets are, what our commitments are, how we're reporting on those, and this is an area which will continue to be a significant focus. We used to have a standalone climate report with all of that information in it, as well as the progress against our own operational emissions and the decisions that we were making from a lending perspective. It's now integrated into our annual report.
So do you have any specific policies on lending to the development of new coal facilities?
We do. We have specific restrictions to thermal coal. We have restrictions about diversification, and there's differentiation between different types of facilities. We've had a policy in place for some time about reducing. I should say at the outset, our overall exposure now 3, 5 or 10 years ago is very small relative to the size of our balance sheet. Well less than half of 1%. But yes, we via a variety of different policy updates, which we typically do every 2 years, we set out some clear expectations about our exposure to make the distinction between thermal coal versus metallurgical coal, and they're all set out in our annual report.
Any other questions?
I might just ask, what do you think the importance of consistent and predictable energy policy is for the purposes of investors and the directing of investment towards projects?
Well, I don't know that I've got too much more to add than to reiterate the answer that I gave earlier in this area, and in many areas, I guess I'm yet to meet an investor that's not interested in consistency and certainty. That's just the factors that drive confidence and valuation. So I think that's sort of irrefutably true.
Thank you very much.
Thank you. Member for Moreton.
Thank you, Chair. So just for clarity, to follow on, you do have a net zero policy and targets for when you'll source 100% of your energy from renewable energy, yes?
We do. We have operational emissions. We talk about the reduction in each of those. One of the subset of that is electricity. We talk about, we currently already purchase through a repurchase agreement 100% renewable. We also have to think about the third parties, particular areas like data centres, and the source and emissions profile around that, and they are all dwarfed relative to the emissions through Scope 3 through our financing decisions.
Do you think that conduct being in accordance with terms and conditions is an adequate test for a bank's behaviour?
No, as I said earlier, I think this is an area where, and I'd say in lots of different areas, there's been really significant shifts. Where it's at a minimum, there are obligations either through regulations or directly through law. There are many examples, and the ones that we've already surfaced earlier, where those obligations are deliberately taken above and consciously in a customer's favour. I just always think there's perhaps a spectrum on where the optimal balance for that is.
Do you think that customers read terms and conditions?
I think it'd be hard to generalise for every customer. I don't know that. I think it'd be very difficult to make that case either way.
How many people do you think would read
across
full-
16 million customers.
Yeah.
I think it'd be hard to guess. I mean, if I had to guess about how many people here read their terms and conditions across all aspects of their life, how many people click on I accept and scroll to the bottom, I don't know.
But I think at the same time, what we certainly seek to do is not only through the terms and conditions, but certainly on our website and all the content that we put out that we try and engage customers in, is showing the simple way to describe the features of the products, what we're laying out in terms of what's available as a result of taking up that option. So yes, it is about the T's and C's, but I think at the same time there's more that we try and do to make sure that we're really clear and transparent in terms of what the product offer is.
Do you think it's more likely or less likely that the most vulnerable people in our community would read terms and conditions?
I mean, I think there's a implicit assumption and conclusion that you're drawing from your own question. I think, you know, the only thing, because I feel like we're sort of relitigating over the same ground, and I'm not sure that I have anything particularly new to add, other than to say it's not necessarily only about the terms and conditions. I've simply stated, and I think it's an important principle at least, that they did operate in accordance with the terms and conditions, you know, as per the original refunds that we've already provided on a voluntary basis, did so, and we're seeking to continue to do so and to find an appropriate resolution that hopefully adequately resolves this matter. But I don't know that there's a generalised principle that would apply across all sorts of different industries, that you just subjectively make determinations. I mean, going back to the questions from an investor expectation, I mean, I think that's a difficult sort of concept to get your head around, or proportion of any income that you've ever charged as any business. There's some generalised expectation. Now, I accept that there's a spectrum here, and of course I'm making some generalisations, but again, I feel like we're going to be going over pretty familiar ground.
I understand. So I might just, for my last question, look forward. What processes and systems are now in place for low-income earners to be put automatically on either low-fee or no-fee based accounts?
Well, I think there's a variety of different answers to that. One will be, I suspect there will be higher obligations to automatically migrate customers.
Are there any processes or systems to put people who are on low incomes?
Yes, as I said, automatically. There may also be sub-cohorts where perhaps you don't automatically need to move customers onto a zero-fee account. I certainly accept the benefits of that. I think I'd probably make the same conclusion that I made earlier. I think time and again in any industry I've ever seen, where there is no commercial model, I'd be stunned if over the long term there isn't a reduction and degradation of services, and simply at some point...
Do you have confidence that this won't happen in the future?
Confidence that which won't happen in the future?
That low-income earners who are eligible for low or no-fee accounts won't be put into accounts that don't fit that criteria in the future?
I certainly will have confidence that there will be additional steps that were taken. I think it's not entirely correct to say that they were put into that account. In many instances, they put themselves into that account. I certainly accept that there is obligations and information that we should take steps to ensure that customers are making the best decisions. But, frankly, I think there's a few sort of leaps in the logic which don't necessarily support that. But to the substance of your question, do I think there are improvements already and underway? Yes, I do.
Thank you.
Okay. Member for Member for Bowman. Do you have any questions for 5 minutes?
Thank you, Chair. I am the member for Bowman, but on the beautiful Moreton Bay, so you weren't far off. Just building off what the member for Deakin was asking around coal investments, I'm just wondering, with gas and critical minerals clearly going to play a big role in the transition, do you feel that your ESG rules are constraining lending to projects operating in those sectors?
Are you referring specifically to gas? Or
yes, and critical minerals.
I don't know. I'm certainly not aware of anything specifically in critical minerals. I think perhaps there's we certainly see the importance of that sector. some subsectors within that are perhaps harder to finance through debt, given certainty of cash flows. Obviously, some of the policy steps, really help to support that industry and help to make debt financing available. Look, I do think there are a number of aspects of our lending policies, not limited to this particular area, that need to be constantly challenged, as you said, and I agree. Gas will play an important role in Australia's transition under any scenario. I think we should continue to test ourselves to make sure that we've got the right settings to, that's appropriately responsive to the national interest and the policies that are consistent with the government of the day.
Would I be right in characterising your commitment to 2050, to achieving net zero by 2050, as trying to achieve assessed emissions in your business lending portfolio down to 2050? Down to net zero by 2050. Is that a correct assessment?
Well, we have, yes, net zero by 2050. There are sectoral pathways within each of those. I think they make an assumption on temperature ambition of well below 2 degrees. We then calculate an emissions intensity for each of those. There's a number of different assumptions. We set them out very clearly. We've expanded those glide paths, and we report against them. We have a realistic expectation that it will not be possible on all of those glide paths. I mean, I think one that's perhaps relevant and outside of some of the topics that are discussed is home lending. The emissions intensity of that glide path will be heavily subjected to or dependent on the electricity grid.
How many sectors are you on track to achieve net zero by 2050?
I'd have to take that on notice. There's certainly some that we aren't, and there would be some that we are. I think that I think maybe more than a dozen particular glide paths. We started out a few years ago with sort of 2 or 3. So I mean,
would you say it's unlikely that the bank is going to achieve net zero by 2050 along those lines?
Well, I think there is, a number of variables and complexities that would make it very difficult to conclude that all of the objectives that we've set out will be achieved. So obviously, a number of them are well outside our scope, but that doesn't therefore mean that it isn't important to have a target and a goal, even if some of those there are dimensions of that outside of our control. And as I said earlier, there's a very clear balance that needs to be struck between reducing emissions, pricing, reliability, economic factors. We think about all of these. I'm sure everyone here does, and we recognise that this is a very long-term and important challenge. I don't think it's one that's going to be resolved conclusively in the near term by any stretch.
Do you think Australia's on track to achieve net zero?
Perhaps I'd sort of defer to the experts that report on that. I think.
Well, you're an expert. You do run Australia's largest company.
Well, I can assure you I am not an expert. I try to have some expertise about all aspects of the Commonwealth Bank's operations. We set out how we're performing and tracking against all of those. I think clearly this is a global challenge that's going to rely on a lot of long-term coordination. I touched on earlier, a lot of new technologies are going to need to be developed and play an effective role. I think there's a number of assumptions that have changed probably even in the last 5 years. There's no question this is going to be a challenging and bumpy path. We're also talking about 2050. I mean, certainly the context that we're operating in, and just more broadly, I've never seen a rate of change that comes close to what we're observing with some of the technological shifts that are currently underway. So, I think there's a lot of potential outcomes, and not all of them as positive as each other.
Can I just drill down one more level on that, Chair?
This is absolutely, you're over the 5 minutes, so if you can put it on notice would be helpful.
Absolutely. Well, if I could just get Matt to put on notice that I'd just be keen to get your perspectives on what are those. You mentioned the assumptions that have changed in recent years, and the factors that you're considering. I'd just be keen to understand what they are, and what lessons you've taken out of those.
Mm-hmm. Happy to take that on notice.
Thanks, Henry, and thanks also as a Queenslander for pointing out a New South Welshman's geographic shortcomings with respect to your great state. Moving on to the member for Reid, and then we'll go the member for Bennelong and the member for Wentworth.
Thank you very much, Chair. And Mr Common, I would like to draw on your banking expertise here and take you back to your response to the lessons out of the Banking Royal Commission. And correct me if I'm wrong, but if I may summarise what I think your answer was that there is now a greater focus on customers and customer outcomes.
Yes.
And I wonder if you might talk about how you are using that focus and that lens in helping to support customers during scams. And I know that there's been a great deal of work done on the prevention and education piece, and I applaud you on much of that work around payer confirmation. I'm thinking more around once they have been scammed, the restitution piece, what you are doing to help support customers during that phase.
Mm-hmm. No, thank you. Look, there's obviously a number of different steps that we're taking, as you said, over and above the education and sort of scepticism that unfortunately we all need to have, given the sophistication that continues to increase over time. Look, I think some part of it as well is having very clear and consistent tracking, reporting, objectives, investments that we're making. We have a coordinated program of investment that we think is going to prevention is clearly the most effective. Given what we're dealing with, which is largely when a customer is deceived or misled and often makes a transaction or instructs for a payment to be made, but perhaps not under the circumstances in which they did. I think, as I said, I think I've already touched on the code. I mean, we've looked across many different sort of scam types. We've sought to try to also sort of retroactively understand whether there's any decisions that maybe perhaps we might take a different view. I don't. There's a real sort of balance within that. There's some real complexity. I think this is good, and this is part of what I was touching on earlier. I think the sort of reflection and reviews to identify in some of those areas. I think we've tried to develop very clear policies and procedures. I think it's fair to say that our approach overall has matured over time. I'm sure it will continue to do so.
In the creation of the scams framework, I think there was a real acknowledgement that we are dealing with a very sophisticated criminal element here. And like you said, their ability to be productive is unparalleled. Oftentimes in scams, there's a culture of victim blaming, and that seems to have shifted now, I think, in the right direction because of the understanding that it is a highly sophisticated environment. If that is the scenario that we are in, what are you doing as an institution to really help support and safeguard the most vulnerable customers who may not have an understanding of the education piece that you do, or even the technological friction points that you have? And I'm thinking maybe older Australians, those with English as a second language, the support that you are providing them in the preventative piece, but once they have been scammed, what support you're providing afterwards as well.
Yeah, look, I mean, I think you've touched on a number of the elements in terms of education, prevention. Obviously, there's a number of maybe more sophisticated techniques that can try to always seek to establish the identity, make sure someone's not performing transactions on someone's behalf. I maybe don't want to go into all of those details. I mean, specifically to your point, there's such a breadth of scam types, and you're quite right. Some of them are very sophisticated. Probably the biggest losses, unless something's changed recently, would be in investment scams. Some of those I think are reasonably easy to detect. Some are not. it also assumes a reasonable basis or an equivalent basis of people's understanding of different, which of course isn't true. We've had instances where we've intercepted and prevented in things like romance scams, and that actually in some instances put our staff in quite a difficult situation. We try to have very clear processes to be able to deal with those. I think this is an important part of the Scams Accord, just increased clarity and expectations of what institutions will and won't do. But I also don't want to create a false expectation that an institution that receives an instruction from a customer to make a payment is somehow then going to assume full liability for all of those payments, irrespective of the circumstances. I'm not suggesting that you're putting that forward. And again, this would fall into a similar category. I can understand why people would look at me or any bank and say, well, hang on, why don't you just, if someone loses money, just give them their money back? I just don't think I think there has to be an understanding of what reasonable steps were, what could have been done, what should have been done. Obviously, there's lots of factors, and I'm not suggesting it's entirely a legal decision, but nor do I think that, financial institutions should assume 100% liability. I think that's one of the really positive aspects of the Scams Accord is that, why would you try and sheet home liability to a particular sector that can't possibly prevent it? Because, as I said earlier, in all of these circumstances that we're talking about, the bank is not the scammer, not involved in anything to do with it. We're just trying to prevent it, help as many customers, reduce their losses, and there's, our approach to compensation we think about sort of very carefully, and that does not, even though the bank, unfortunately, in some of these circumstances, is not at fault. I see firsthand the difficulties that causes in individual circumstances. When things go bad in financial services, the impact is large, and I think that's clearly a very obvious lesson from the Royal Commission.
And I would just add, though, specifically around your point about elderly or multicultural, different languages. We do have an extra care team as part of our hardship team. Obviously, they are dealing quite frequently with customers who have lost money through this exact process. So we do put a lot of effort into making sure that they're trained to deal with empathy and really kind of understanding and trying to help as much as possible. So everything Matt said, but at the same time, how we show up in that moment to help, we're very focused on, but obviously the prevention side is the most critical.
Thank you. So, member for Bennelong, then member for Wentworth.
Someone opened the net zero box, I'm going to jump in. Your 2025 annual report states this: we believe affordable, reliable energy is critical for Australia's prosperity and future economy. We remain committed to supporting Australians' transitions to net zero by 2050. Is that still the case?
Yes.
Why is that?
I think for all of the elements that are contained within it, and probably some of the text that's around it. We think it's, as I've touched on multiple times, I think it's a very, very challenging, but notwithstanding that, long term will be important. And as I've tried to avoid, but perhaps unsuccessfully, I'm not seeking to insert myself into the political debate. We certainly understand that reasonable minds will differ, particularly in the near.
You don't want to do it in this place.
I don't seek for you to. My questions revolve around your 2025 annual report.
Certainly, I do think emissions and decarbonisation are important and complex structural issues that will need to be dealt with.
Your commitments are there and are based on the need to align with 1.5 degree scenarios. That's in your report. You talk about the impact of climate change on infrastructure and natural disasters as well. These are things that the CBA are well aware of and are taking action to be part of their net zero commitments.
I mean, unless I'm mistaken, the individual glide paths are on a well below 2 degrees, not to sort of get too much into the semantics. Sure. But on aggregate, obviously, if they're all below, let's say it's 1.8, then you can get sort of a weighted average of 1.5. But regardless, and clearly some of the temperature ambitions are very challenged. Mm-hmm. But yes, we seek to make clear what our commitments are, what we're doing, what we're thinking about it, what steps and reporting against those. And as I said, every 2 years, at least every 2 years. We will update our framework policies, and to the extent that we think that it's necessary to make changes to those policies to better support Australia, then that's what we'll do.
The government's recently set 2035 emissions reductions targets, and accompanied with that was Treasury analysis on those targets. Are you aware of that analysis? Or elements of it?
Elements of it,
yeah,
yes.
Sure. Basically, there are 5 conclusions from that analysis. Number 1 is Australia can be a primary beneficiary of the global net zero transformation if Australia continues to take decisive action on climate change. Is that a statement that you agree with?
Yes, I mean, I'd obviously add the sort of compensating. There's a range of other factors, and I do think some economies and communities and some of the other factors. But yes, I don't think I'm going to have, particularly in a truncated version, many difficulties with what I suspect you're going to put forward. But you continue, Mr. Laxale.
That Treasury analysis also says clear and credible climate action will lead to more jobs, higher wages and better living standards for Australians. Is that something you agree with?
Look, I always want to see what the assumptions are that are driving that, but I certainly, like, as a point of principle, yes, I don't sort of seek to refute that, but I mean, that it's not our statement. I think broadly we would our views would be very consistent with a number of the conclusions. I'm aware of the emissions target. I think it's stretching, but it's an ambitious target by its design. As I've touched on many times, I think it would take a lot of work. We haven't sort of changed anything in our posture. We think long-term this continues to be an important issue.
An orderly net zero plan gives businesses the clarity and certainty they need to invest in Australia with confidence. Is that something you would agree with?
Yeah, as I've touched on, I think consistency and long-term planning is, I think without exception, is a good thing for businesses. Perhaps in some cases that's harder to provide, but that's always desirable.
Thanks.
Over to you, member for Wentworth.
Oh, sorry, I just wanted to say it's actually the glide paths are 1.5 and the ENS framework overall is well below 2, so just to clarify.
Thank you.
Thank you. Member for Wentworth.
Thank you. The government passed its scam prevention framework in February, but still waiting on development of the industry codes. Have you seen any drafts of any industry codes?
Our team have been involved in them. I've seen I've certainly seen the updates. I've seen the areas where there is still some clarification. I've certainly seen the aspects of banking. I don't know what aspects, if any at all, of the other industry codes have been shared. I know Treasury's working on them, and I know our team are very engaged in it. And as I said, it's an area of focus for all of the banks and will be a topic of important discussion at the upcoming ABA meeting. So I do think that a lot of progress needs to be made rapidly. There's some real complexity associated with it, and to get to a sort of mid 2026 implementation date, it's going to require a lot of focused effort and cooperation or coercion across the multiple sectors.
Well, talking on that, are you satisfied with the current engagement between sort of banks, telcos and digital media on scam prevention as it is?
I couldn't comment sort of confidently about what level of engagement there's been. I think certainly in my personal perspective, the engagement with the telco industry and certainly some of the telcos has been quite effective. There's certainly been engagement with the tech industry. Perhaps my natural conclusion or inclination, I'd want to just double check before I form that conclusion.
Okay, thank you. Do you think that customers should have access to institution-specific data relating to, how effectively their institutions are both either sort of facing scams or how many of their customers are facing scams and also scam losses, but also reimbursements?
Look, I think, like many things, some form of reporting and transparency is generally a good thing. I haven't thought to what level of specificity, would be helpful. I think ultimately for many individual consumers or businesses, they're interested in their specifics. I do, I think having clarity of expectations and performance across the industry to lift all boats and more of a race to the top. I think generally a positive force, definitely.
Okay. To switch gears, this is a bit of a perhaps unusual question, but I know we've asked you all a lot of questions. I guess I think there's also, we have a role I believe, parliamentarians have a role to also to be listening. Are there any things that we haven't talked about you think where we as the Economics Committee or individual politicians should be thinking about that is not being covered in our discussions? This is your moment to tell us your opinion on things.
No, thank you. I appreciate the question. How long do I have? Well, how long do I have? No, look, I mean, I've appeared many times. I actually, sadly, probably enjoy it more than I should. I think the accountability and transparency is good. I deliberately tried to cover what I think to be the most important topics that at least we're thinking about and facing into at the moment. I did that some way, which I won't repeat, but I think there's a number of elements within that clearly we think they're important. I think they go to some way to explain a number of the topics that we've talked about. I dare say in 12 months from now, unless you want to increase the frequency, there'll be other questions and decisions that you may be asking about that I think will tie back to some of those comments. And that's specifically what I wanted to be able to cover, is to give you, a sense of some of the issues that's within the industry. So I certainly feel like I've had every opportunity to provide that. Okay.
Then my final question then is on tax, which is to say you have been previously on the record in relation to the tax system in relation to personal income and young people. And I guess I'm interested in to see, your position, your kind of views sort of unchanged, and how much do you think this is a priority?
Yeah, my views are unchanged, and you know my views. Look, it's a view of one. We also try to, as I said, contribute as best we can across. We get a lot of feedback from customers, sometimes in tax, but obviously in a lot of other areas. I do think there's a real challenge on younger Australians, workers, access to housing. Worry a lot and can see some of the the rising inequality. I think it's very difficult, and I think anyone who gets close enough to some of the politics can see the challenges around that. I do think that some broader package versus, which is of course very, very difficult, but where there are some gives and takes across multiple groups would be important. I'm sure like everyone else, I worry that the ability to sort of compromise and come up with an overall compact which makes Australia better, which hopefully if we can play any role in that, a constructive role, we certainly seek to do that. I think it is hard. There is a lot of focus always on perhaps the one person or the one group that will be disadvantaged, but I think there's a number of things in totality, and at least I appreciated the opportunity to be able to participate in the round table, and I think it's a good process to have a dialogue and a decision. And yes, if there's more that we could be doing to support that, certainly not diminishing the difficulties, then we'd be very happy to play our role.
Thank you. Now, because the member for Casey exceeded his 5 minutes, he's got one question on AI, and then we'll wrap up.
Yep. Does Commonwealth Bank receive any taxpayer funding as part of your journey to net zero?
Hang on, you said. Oh, go on.
Yeah. Sorry, chat. Yeah.
My answer was going to be no. I'd have to check whether, in the context of anything with Clean Energy Finance Corporation, I don't think we're receiving it, but I think perhaps there's some very small support. I think, by and large, there is. I'm not suggesting it should change. No contribution from the government to the banking system financially.
Just to confirm,
I'm happy to.
Appreciate that. Thanks.
Yeah. Righto. Well, thank you very much for appearing today. The committee secretariat will be in contact in relation to any matters arising out of today's hearing. Obviously, a lot of questions have been taken on notice. You'll be sent a copy of the transcript of your evidence, and I'll have the opportunity to request any corrections to transcript errors. And so with that, I'll again extend our thanks for your appearance to you both, and I'll suspend proceedings and we will resume at 1:30 p.m. Thank you. Introduce myself to a new concept of punctuality. Welcome. I just want to welcome Mr. Miller as the CEO of the Westpac Group. The public hearing will now resume, and obviously I extend that welcome to all representatives of the group. For the benefit of Hansard, can you both state your full names and the capacity in which you appear before the committee, starting with you, Mr. Miller?
Anthony Miller, Chief Executive Officer, Westpac Group.
Ryan Zanin, Chief Risk Officer at Westpac.
Terrific, thank you. I remind you that although the committee doesn't require you to give evidence under oath, the hearings are legal proceedings of the Parliament and warrant the same respect as the proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as a contempt of Parliament. So with that warm welcome, Mr. Miller, if you'd like to make an opening statement, I invite you to do so.
Okay, thank you,
and
Chair.
thank you for tabling the one that you did.
No problem. Thank you, Chair. It is a privilege to appear before you for the first time as Chief Executive of Westpac. Today I'd like to cover 4 areas that are central to Australia's economic and social progress: the state of the economy, productivity, our payment system and regional Australia. Australia's economy remains strong and is showing signs of improvement in the face of global uncertainty. Recent interest rate relief has provided welcome support to households and contributed to consumer sentiment reaching its highest level in 7 years. Larger businesses are reporting improved trading conditions. However, small and medium-sized enterprises continue to face headwinds, especially around the availability and cost of labour. Westpac is well placed to support our customers through this period. Our capital position is strong, providing a solid foundation to navigate these times and support lending to the economy. Encouragingly, 90-day mortgage delinquency rates have declined to 0.73% on our mortgage book of over 1.6 million customers. Pleasingly, 75% of our customers who enter hardship situations move out of hardship within 3 months with support from the bank. We have seen hardship applications slightly down year on year, which is a positive indicator of the easing cost of living pressures. One area of challenge in our economy is productivity. Without its improvement, we cannot lift living standards or remain competitive on the global stage. Addressing this challenge requires a coordinated national response with government, business and community working together to unlock the next wave of growth. We need to prioritise and tackle the key drivers of this next round of economic growth: increasing housing supply and affordability, investing in regional Australia and embracing new technology by training our workforce and ensuring Australians have the skills, the confidence and the tools to innovate and adapt. Turning to payments, Australia has a world-class payment system that delivers real-time payments for individuals and helps ensure that the small businesses benefit from near instant availability of funds. This is the result of significant investment by domestic institutions, making our payment system fast, safe and dependable. As we consider the future of payments regulation, it is essential that we take a holistic view, one that considers both domestic and international players. Our regulatory framework needs to create a level playing field for all participants so that value generated within our system continues to benefit Australian consumers and our economy. I would like to recognise and thank the Reserve Bank Governor's recent decision to extend the review of merchant payment costs and surcharging. We have publicly noted our concerns with the proposed reduction in interchange fees. The proposal only targets Australian payment service operators and provides a free pass to global giants participating in our system. This approach would simply send more payments, revenue and tax out of Australia. With the amendments to the Payment Systems Regulation Act now passed, the RBA has the opportunity to consider the full domestic and international payments ecosystem, and we look forward to working with them through the next phase of consultation. I expect payments will be a topical subject during these hearings, so along with this opening statement, I have tabled 2 slides on the payments ecosystem that I may refer to. In closing, I would like to update the committee on the regional banking announcement we've just made. Regional Australia is a national asset, home to 1/3 of our population and responsible for around 30% of GDP. Strong regional communities are vital for a strong Australia, and we want to make sure these areas have access to the banking services they need to prosper and grow. That is why we announced an extension of our regional branch closure moratorium through to 2030. This will give us more time to develop and improve the way we provide sustainable banking services in regional Australia. We are thinking differently about how to serve communities in an increasingly digital age, and while still providing people with someone to talk to when they need it. We aim to serve the customer where and how they want to be served, digitally, in person or virtually. We will be opening new banking service centres in regional Victoria and Tasmania, following the recent opening of our Moree Service Centre. We will also be launching a new community banking service pilot. The pilot will see Westpac establish a part-time face-to-face banking service in 3 regional towns, with a banker working from a local government office or local community organisation. I am pleased to confirm that we have spoken with Dungog and Tamworth councils, and our trial will start in Dungog, Manila and Bulahdelah communities in New South Wales. This model has been successful for Services Australia and Services New South Wales, and we will trial it to provide banking services for communities without major bank branches. Assuming this model proves successful, we will roll it out to every state in Australia throughout 2026. It is important to note that success or otherwise of this trial will be driven by the community's take-up of our service. We cannot offer services where there is no customer demand or where there are other challenges such as employee availability and safety. We have made some mistakes in the past when it comes to closing regional branches without exploring other options to serve the community. We acknowledge that and we are fixing it. That said, I'm confident we have a good plan in place, and by partnering with local governments, we are well placed to build strong partnerships with these communities. Thank you. Ryan and I look forward to your questions.
Terrific. Thank you for that. Just an administrative matter. Does any member object to these documents being received as exhibits? No. If not, we will, and we'll proceed to questions. Big focus. Obviously, this committee was set up at or about the same time as the Royal Commission into banking, and so my initial questions will focus on that, and I'll be focused on that with every bank that is appearing here. Westpac last provided a formal update on your institution's implementation of the Royal Commission recommendations in September of 2021. So how frequently are you formally reviewing your implementation of the Royal Commission recommendations, and when will you provide another formal update publicly?
Thank you, Chair, for the question. We have completed the implementation of all the recommendations that have come out of the Royal Commission. It is something that we have spent a lot of time, money and effort on over the last 7 or 8 years to make sure that we did deliver on those commitments. I would say that the last time we gave an update was in September 21. I'm more than happy to provide a more public update going forward, or send to you materials to sort of, if you will, close that out. I would also say that, you know, the lessons learnt in the Royal Commission, and in particular the lessons learned for Westpac, as we obviously also dealt with issues that followed the Royal Commission, have been well and truly entrenched inside Westpac. We are very focused on making sure that we don't let the standards slip. We've worked very hard to ensure that the bank meets the standard that the community is entitled to expect from us, and we're working diligently to make sure that we maintain that standard as we go forward. And so, for example, all of those practices, policies and disciplines that were set up following the Royal Commission are very much embedded in how we think and operate and lead the company.
Right. So a key recommendation from the Commission, recommendation 5.6, required, quote, all financial services entities to assess, as often as reasonably possible, the entity's culture and governance, identify any problems, deal with them and determine whether or not changes have been effective. Obviously there was a bit of breadth in terms of the Commission. It wasn't just looking at the Royal Commission just at customers, but also internal culture and employees. Now, I note last week that your institution signed an enforceable undertaking with the Fair Work Ombudsman after underpaying nearly 47,000 staff, and the Ombudsman stated that, quote, underpayments occurred over an 11-year period were primarily caused by failures in Westpac's systems, governance processes and compliance oversight. So are you comfortable about that situation, even though it will be from a HR or employment role, that the fact that your governance processes and compliance have been singled out concerns me? So what's been done to determine whether the changes you've made to governance and culture have been effective, if you've got that occurring?
Thank you for the question. Those relate to events which occurred prior to 2020, and so the work over the last 5 years has been very much about making sure that we have in place those standards, those protocols, those policies and that governance to make sure that doesn't happen. Obviously, we got that wrong in relation to our employees, and we've addressed that. And we have, I think, lifted our policy, our process and our governance to make sure that doesn't happen again. I would also add that, we have over the last 5 years had to work very much on improving our entire operating cadence at Westpac to improve the way we run, govern and operate the company. And pleasantly, I think that investment and that effort has been recognised with recently APRA removing the enforceable undertaking that had been imposed upon us in late 2020. That was removed 2 months ago. And I would say that that was a very significant program of work and a significant uplift that's occurred. And so therefore I do feel like we've resolved it. I would say though, Chair, that what is important from where I sit is that we are relentlessly focused on making sure we don't slip back, that we deliver on those commitments and we deliver on those standards that the community is entitled to expect. And I sort of share with you that there's not a leadership meeting that I don't host where we don't review the lessons learned from the past and go through with the team, what we need to make sure we do not fail going forward. And so it's part of what I think is the sort of unconditional commitment we have to set that standard through the company. And as I say, we take it very seriously.
So taking on board that final point, the reference with respect to your leadership teams and the meetings and the reinforcement of some of those points, do committees of the board actively assess Westpac's response management to the Royal Commission, and how often is a feature of board and executive management business and discussions?
I'll invite Ryan to add his additional thoughts on this, but certainly the whole program in which we've set up our governance around risk management within the bank and making sure that the commitments we made and the standards we've agreed to meet are met is all organised around making sure the accountability does follow through the company. And so, yes, the board risk committee through to the group risk committee and through all of the other divisional risk committees does focus on, are we meeting those standards? Are we delivering on those commitments that have been made? And then, of course, not just, if you will, sitting inside the risk committee governance, it's about how we run the company. And are we making sure that every person takes accountability for that standard that we need to meet in serving our customers and delivering them products and services to the standard they expect.
And before you hand over to your colleague, can I just ask, are there metrics or KPIs to those expectations, and do you report on performance in either your annual report or to shareholders or to regulators?
Certainly where we can metricate it and it makes sense to metricate it, we do. Yes, we do, and we review consistently where those metrics are. And you have things, for example, such as that's recognised as green because it is meeting the standard we want. There could be instances where we're not happy with what we've been delivering, and so it's recognised as amber. That means and catalyses that actions have to be undertaken. Who's accountable for those actions? Are they getting done? Are we making sure we're delivering them to the standard we need to be? And those are publicly available and accessible? There's certainly a plethora of material in our annual disclosure which reveals and shares how that is, if you will, pulled together. There's obviously a huge amount of source documents that sit inside the company that, if you will, layer up into that governance that I've just described.
Chair, we have a formal program that we work across the company on risk culture. To Anthony's comments, we don't think the work on risk culture is ever done. It's something that we have to continue to prosecute. And that includes from the people who are at the coalface of talking to our customers and answering phones every single day, trying to help customers out, through the management team as well as to the board of directors. We have an active engagement program with our board of directors where they go out and they do culture assessments across our various teams around the company, and they bring back their own thoughts. We also provide the board with a metricated risk dashboard where we assess almost 20 metrics to give the board a sense of where our risk culture is going.
Is that publicly available?
It is not publicly available. It's part of the deliberations that the board takes under advisement as they discuss the advent of risk culture.
Do you share it with regulators?
It is available to our regulators.
Thank you. Okay, moving on, we've had quite a bit of discussion today about the situation where a number of banks knowingly kept customers in high fee accounts despite qualifying for an account with minimal charges. And that's as a result of the ASIC work. And I'm just wondering if you can, I think from memory, your organisation committed to refunding a shade under 10 million back to customers. And ASIC provided participating banks with a range of recommendations to reduce that harm. Can you give us an update on the work done to refund those customers and how much has been refunded? And can you also outline the steps the bank's taken to implement the recommendations of the ASIC report?
So we are in the process of refunding as per our commitment to ASIC. That should be complete by approximately next March. What we are doing in the meantime is, to the extent that, for example, accounts haven't been migrated to the lower fee, we're rebating the fees because there's a systems issue that has to be navigated. So we have responded to the proposition or the challenge set by ASIC, and we are and have agreed to refund those fees to, first of all, it started in a Better Banking Indigenous Communities initiative, and we've addressed that, and we're now proceeding through the cohort that ASIC identified in July 2024, which is a sort of lower income and, again, a demographic where concessions are provided, and so we're now currently completing that work of rebating fees that have been collected from them.
So how much money has been refunded? And, sorry, can you just remind me the steps taken to implement the recommendations?
So I'll have to take on notice just the exact amount that has been refunded, but it is going to be in the order of $9.9 million. And I'll have to just confirm for you just exactly how far through that we are. But what we have done is identified all of those customers on concession where ASIC's view was that they should have had a different account. What we're now doing is also looking to migrate all of those customers to a lower fee, different form of account, but we provide them with an opt-out. Previously, the bias might have been to go and say, you might want to take this choice of moving to a lower fee setup. What we've done is we'll move them to the lower fee arrangement. And as a result, if they don't want to avail themselves of that account and what it does or doesn't do for them, then they can opt out. And so I'll have to confirm the exact number in terms of how we've progressed that, but we will have completed that work as well and targeting by next March 2026.
Okay, and can I just clarify, do customers have to, in some cases, it's a requirement that customers apply for what is known as a goodwill, it's been described as goodwill adjustment. Are you just doing with the 10 million, are you just providing that without waiting for an application for that money to come back?
Yes, our approach was to focus on that cohort of customers identified by ASIC and then proactively refund, or to ensure that they are rebated a fee that's incorrectly collected until we move them onto the new account.
Right.
And so that's that model I've described to you.
And do you require customers to provide physical concession card evidence or attend a branch to get those, to access those low fee options?
That's certainly one thing we would seek from our customers. Having said that, what we can and are able to do is to identify payments that are coming into their account and the source of those payments, which then gives us further confidence as to their position and, if you will, their status. And then as a result, we can proactively move them into a different account. But what we need to do is give them notice that we're doing that, and then give them the opportunity, if they so wish, to opt out. And so that was the approach we adopted here.
So in providing that physical evidence or to attend a branch, how do they do that in an area where you may not have a branch presence in regional Australia or remote Australia?
And so hence the, if you will, the timeline that we've employed to get that done correctly, because you're right to call out that we need to be very thoughtful about how we do that. We need to be sensitive about how we do that. And there will be customers that, for example, we can't connect with or haven't been able to connect with, and how do we make sure that they feel appropriately engaged with and given notice that we're doing this, and therefore given an opportunity to say, no, please don't move me across to that new account. I'd like to stay. And so that's why it's sort of a methodical, somewhat arduous process to get it all done, and our goal is to have it done by basically March 2026.
Understood. I've got a series of questions in the remaining time that I have around the Financial Abuse Safety by Design toolkit. And just what action Westpac's undertaking to tackle financial abuse, and if you can provide an update on the development and rollout of that Safety by Design toolkit, including the implementation status within Westpac or any other measurable outcomes you've had.
Well, I might invite Ryan to add his additional comments on this. Financial abuse is something that we are very focused on. It was part of our submission to the Productivity Roundtable a couple of months ago, which is that the current drain on Australia's productivity is in the order of approximately $4 to $4.5 billion as a result of financial abuse. And so we've been focusing on what are those things that we should be working on to provide as much protection as we can in how we bank our customers and protect our customers. One of the things, just to call out, that we thought was very important, and I think is within the gift of the regulatory setting, is to have a national register of powers of attorney, because one of the bigger problems or sources of problems in relation to financial abuse is the misuse of powers of attorney and the misuse by people who were perhaps once trusted and now cannot be. And what we see is, for example, patterns and behaviour which suggest to us that actually there is a misuse or an abuse going on, and it is sometimes quite difficult for us legally to so intervene. And so, therefore, in terms of designing a model going forward, it's about building in upfront consents, upfront concessions as to what we can do to protect you from potential financial abuse. And of course, that ranges from elderly to vulnerable to domestic, violence-orientated situations.
Yep. And do you have any metrics or evaluation tools being used to determine whether or not those principles are reducing instances of technology-facilitated and financial abuse, and when will those be reported publicly? And sorry, Mr. Zanin, if you wanted to add to any earlier question as well, please feel free.
In terms of, I'll have to take on notice giving you the specifics on that. We do very actively look at, for example, the misuse by people in terms of messaging, and for example, one of the common examples that's incredibly frustrating and saddening is payments made between obviously potentially a divorced couple or an alienated couple, and the abusive language attached to the payment of whatever has been agreed. We're actively managing that out, actively addressing that, and also on occasions where the counterpart is misusing that, we look to suspend their access to the bank.
We were pleasingly part of the ABA's work and offered up the design of the toolkit through the ABA. We've also provided it to smaller banks to white label to assist with their customers. We kind of take a for our framework, recognizing vulnerability, responding in the moment, and recording circumstances of customer issues with their consent. And then we refer customers to specialist teams that we have in our customer relations teams to help them with moments of vulnerability. The team takes vulnerability, and particularly financial abuse, extraordinarily seriously, and we work with our customers to try and prevent and diminish that. Unfortunately, it tends to be an increasing trend in society, and that's why Westpac and other banks have to be continually vigilant to help our customers in those vulnerable moments.
Okay, thank you. Look, I have some questions around artificial intelligence that I might ask later, because I think if we start now, we won't get a chance to finish them. So why don't we move to the Deputy Chair for the next 20 minutes, and then we'll come back to that issue later on.
Great. And thank you very much, Mr. Miller and Mr. Zanin, for coming today. And we're on short time, so if I do interrupt you, I'll just say that's fine. Let's move to the next question. I may do that. But firstly, on housing, I heard you talk about housing in your opening statement as being one of the big challenges under productivity and affordable housing. Following the launch of the government's 5% deposit scheme, property prices grew at the fastest rate in 2 years, with price increases most concentrated in the bottom of the middle market, where first home buyers were most likely to be found. And I think the AFR said today the bottom end of the market has been growing more quickly for the past 2 years and has been rising up to 10 times faster than wage growth. So my question is, have you seen an increase in demand since the 5% deposit scheme began, and can you confirm that this higher demand is leading to higher housing prices?
So we have 1.6 million customers who we've provided a mortgage to, and approximately 29,000 since the 5% deposit scheme effectively came in place. So that gives you some proportion in terms of the level of activity. I certainly think that in the context of looking at housing prices in Australia today, there's certainly an increase in prices that is sometimes worrying in terms of people getting access to property. And so, from where we sit, the challenge remains simply how do we get more supply of the right houses at the right price point to ensure people within Australia can buy a property that they can afford. And so I don't think the home buyer scheme, first home buyer scheme, is the driver of housing prices. The simple proposition is that we have more demand than supply is the key driver there.
What about, because it's got caps, Sydney's 1.5 million, I think Melbourne's 800,000, Perth 700,000, but what about under those caps? Of course, it's not driving all demand across the market, but I think particularly given it's expanded in October 1st, where it's available to everybody, it's no longer... I wasn't suggesting it would be driving all demand, but under those caps for those areas it's targeted to. And that's where they're seeing it in today's AFR article growing much, or I think it was like 1.2% for there and maybe under 1% for the rest of the market.
Yeah, I'd have to sort of spend some time looking at the underlying data and analytics to sort of, if you will, assess that observation or be able to sort of confirm that potential hypothesis is proved.
No worries. Elisa Owen from Coality said, economists have been saying for a very long time that the way to address housing affordability is not to increase money concessions or grants. Is she wrong?
I'm not able to say if she's wrong or right. What I would say is that the number one challenge in housing in Australia is to build more houses at the right price point. That is the key challenge in front of the country. It also represents probably one of the most attractive growth opportunities any country in the world has had. And so, facilitating and putting in place all of what needs to be done to drive more house construction, I think, is an enormous opportunity for the country.
One more question on that scheme, and then I'll come back to your comment on the thing is to build more supply. But the Barefoot investor Scott Pape argues the government's 5% deposit scheme will, quote, trap young buyers into becoming postcode povos, saying with the maximum debt and minimum buffer, you're one bad year away from disaster. He then goes on to say a 5% deposit on a median dwelling of at $850,000 would have $841,000 of interest. That would be an extra $132,000, $936 in more interest. So do you agree that the most vulnerable who use the 5% deposit scheme could pay hundreds of thousands of dollars more in interest?
I certainly agree that if you've got more debt, you're going to pay more interest. When we are and do assess the borrower for those particular, we're very focused on our responsible lending obligations. So we are assessing whether they can afford and can, if you will, sustain the serviceability of that mortgage, and that's an important, if you will, obligation we have, which I think gives us comfort around are we getting that right. Certainly, anyone who's buying a house in Australia is pursuing that dream, which is you buy a house, you pay your house off. It's a fantastic savings vehicle. Everyone is buying a house with a view that the journey of the last 40 to 50 years, which is house prices continue over every 5 to 10 year period to go up, everyone is buying their property or buying a house with that goal in mind. So to the extent that they sit there and think about the amount of debt they've got, the amount of interest they're paying, and that over time, what does that look like? They're also weighing up the fact that they expect and are buying the property on the basis its value will increase over time as well.
But those buyers having a lower risk buffer, saying they're one bad year away from disaster, is that a fair comment or not?
I don't think I'd characterise it like that. What I would say is that we definitely assess whether they can afford to service the principal and interest on the property. What we've also noticed in particular is that the performance of that cohort over the last few years is where our average book performance is, and in fact potentially just a slightly better. So we're not seeing, if you will, underperformance or more challenges in that part of the book. But ultimately, the key observation I'd share with you around how we think about the risk that emerges in the book, the mortgage book, is simply unemployment. If unemployment, we've had a tremendously good run in this country for 30 years from effectively an unemployment level. If we continue to have these low levels of unemployment, then I think we can be very confident that you won't see any disaster or otherwise realised.
But if unemployment spikes, what could happen?
If unemployment spikes and stays quite high for a period of time, then that will introduce stress into the system. But I think we've seen over the last 30 years, and we can see the focus right across the community, political, regulatory and otherwise, around making sure the country is growing and jobs are being created.
And over the last couple of years, do you feel housing affordability is improving or deteriorating in Australia?
I think it's just as challenging as it ever has been to buy a property. I do think, though, there's a lot of initiatives that are helping. I would argue that we need to spend more time, more focus and more effort around building properties in that price point that are going to solve for the majority of Australians. And so we think more work around building properties in that $500,000 to $600,000 price range will solve the challenge for the majority of Australians.
And we've heard over and over people saying, look, let's build more supply. I do want to come to demand, but just before I do that, and this isn't you, it's a banking system question. So my understanding is a retail bank makes a net interest margin, which is the profit you make before any operating costs of a loan of sort of 2.5%, something like that. Is that ballpark?
It's so dependent upon the term of the loan.
But of your retail book, of your whole retail book?
I think it's less than that now in light of the competitive environment that we operate in.
2%? Do you know what it is?
I have a sense of that. I don't look at it that way. I'd look at a net interest margin that's much lower than that. So what I'll need to do is back out certain costs and other calculations you've added in there or haven't added in there.
Okay, but I think the point is for all the billions of dollars of mortgages you make a fixed margin on that. Is that fair? And maybe it's around 2%. You'll have to check, but is that how it works?
Yeah, we make a margin. That's right on any loan we make. But then when the housing market goes up, you've got a fixed cost base there. So say the housing market accretes 10%, and we get greater supply through greater immigration or whatever. Does that translate to greater profit for the banking sector? No.
Why not?
So our loans, we make a return which is the cost of funds of the bank, and then obviously there's the cost of running the bank. There's the cost of the capital we have to hold to support the loan that we've put out, and then there's the return that we make in terms of the interest paid to us on the loan.
But you don't make a greater profit. You say you're selling the same volume of houses, maybe you sell more. You don't make a greater profit if it's a greater sized loan.
You have more revenue, but the profitability may not be more just because you've got a larger loan. No. So the profitability is...
You're telling me when house prices go up, you don't make more money? You're telling me that's not true?
No. To the extent we make more loans and make larger loans, then we charge, obviously the math follows that we charge more interest and we collect more interest. But that does not necessarily follow that our profitability is higher because my costs also go up.
But don't you price those mortgages so you make a profit on those mortgages? So you're telling me when housing prices go up, you don't make more money. You don't think that's a given. You don't think increased bank profits are linked to increased housing prices?
No, I don't think they're linked as directly as you're suggesting.
My understanding is because you have if you have a net interest margin, what is that telling me? You're making margin on the interest you collect.
So I lend money to the customer. They pay me $100. The cost for me raising the money, holding the capital means that it's $80 to provide that $100, and I get $20. That's my net interest margin. That's the profitability.
So you are making more money the greater interest you charge, the greater the loan size, the
we
greater
make
the house
more money,
price.
but I suppose what I'm drawing to is we make more money as loan sizes go up and more interest is collected, but the profitability does not necessarily follow just simply because your balance sheet is larger or because your loans are larger.
For sure, but are you cutting mortgages you're running losses on right now, retail mortgages? Are you issuing mortgages, retail mortgages, that you're losing money on right now?
So we currently, our mortgage book does not make the return, or the target return on cash.
Are you losing money on your retail mortgage book? It's a simple question. So you're not. You're making money on that book. Are you cutting any individuals? Can you name a single mortgage where you're losing money on, a retail mortgage where you would lose money?
At this point in time, a single mortgage.
Would there be a single customer where you're losing money on?
I'd have to check that.
Because I think it feels like that's a little bit evasive. If you're saying, look, you're not making money as house prices increase, I understand you might not want to say that, but if you can't tell me you don't think there's a single customer where you're not making money on.
So, we lend money, we get paid money in relation to the loan.
Yeah, and I think
whether we make a profit on that or whether we make a return that our shareholder wants is sort of the second order question, which is the current return on our shareholder capital that we allocate to the mortgage book is below the target return for shareholder.
So it might be below your target return, but it's still profitable. The point I'm making is the more mortgages you cut, the more money you make, the more houses that we sell, the more money you make, and the higher house prices go up, the more money you make. Can you give me a specific example that disproves any of those statements?
I acknowledge that if we lend more money, we make more money. Whether we
That's
make
all I was
more
trying
profit,
to get to.
whether we make more profit or not is a different thing entirely.
That's where I was trying to get to.
Chair, I would just offer up that one of the things to note, as Anthony mentioned in the beginning, is that our net interest margin as an industry is down 55 basis points over the course of the last 25 years, despite a significant increase in house prices. So your point is well taken. The more loans and the larger loans we make, the larger absolute revenue we make because we charge interest on loans. But the net interest margin, in fact, as a basis points, has come down.
Yeah. So that's why I just wanted to, and now I want to move to demand and supply, because I understand more supply will lead to more absolute revenue and more absolute profit if you're making money on that. But on demand, what's your view on immigration and or risk weightings or how much we're lending to mortgages into what's that doing to house prices?
In terms of immigration?
So the demand side, I look at the demand side in two ways. Volume, which is the lever we control at the federal government, is immigration. There's birth rate, but we can't control that. But as a federal government, we can control immigration. And then secondly, the other area I think we can control or have some influence on is risk weightings or access to credit. And then I'll have a couple of follow-up questions on that.
Okay. Well, certainly immigration and so population growth, whether that be natural or immigration, to the extent that they want to have access to property or own property, does increase demand. And unless you solve by increased supply, then the outcome would be that would put pressure, as I understand your emphasis, would put pressure on prices.
Yeah, and I think this morning I asked Matt Coleman a similar question on immigration and said, I said, what's that doing to housing demand, the government target in supply? And he said, on a quote from the Hansard, perhaps the right number is something in the order of 180,000 per annum. It gives both the Commonwealth and the states the ability to plan for critical infrastructure, including housing, end quote. Does Westpac have a similar view to that? Does your economics research team have a view on that?
I'll have to take that one on notice because we have done work on that, but to the extent what is the number we think is that happy balance that ensures we get the immigration we need, the skilled migration that we need, and thus can be solved by, satisfied by the infrastructure spend we need to make, the infrastructure investment we need to undertake. I'll have to come back to you and confirm that, but I'm sure Matt's very close to right, if not right, and I'll come back to you on notice on that one.
Yep, no, sure, thank you. Just on interest rates, do you have a view for the likelihood of interest rates coming down in the next 12 months?
At the moment, our official forecast is that there would be likely 2 rate cuts next year in May and August, and so that's the current view.
And has that view changed over the last 6 months or so?
We certainly, no less than 2 months ago, thought there would be, and anticipated there might be a rate cut in the first week of November. So we thought there would be a rate cut in November and then one in May and then one in August next year. That was our forecast. But then obviously about a week or so before the November meeting of the Reserve Bank, certain inflation data was revealed, and that suggested actually it's still a reasonably buoyant and sort of inflationary setting, and so we anticipated at that point then the Reserve Bank would be more cautious and would hold any rate cut until it sees further improvement in effectively the trend mean inflation rate.
Yeah. Just back on credit and how you issue credit. 30 years ago, the Australian banking sector was roughly 2/3 business loans, 1/3 retail, mainly mortgages. Today that's inverted, where it's 2/3 retail, mainly mortgages, 1/3 business. Any comment on how that's transpired?
Well, certainly, if you look at the journey the Australian banking system has gone on, in the 80s and 90s, commercial lending was the dominant business practice, and certainly at half at least, and often upwards of 3/4 of the balance sheet was on commercial business lending. With the stresses that the system went through, and Westpac in particular, in the early 90s, there was a recalibration of, if you will, risk and how to think about risk and the risks that follow from business and commercial style lending. And as a result, you saw a rebalance of portfolios, and we've seen the growth in mortgages as a proportion of balance sheet. It's been an inexorable growth on that over the course of the last 30 years. And so at this point in time, it's approximately 65 to 67% of our balance sheet is mortgages relative to commercial and business, which is a reversal of where we were perhaps in 1990.
Economy-wide, do you have a worry that's having an effect on productivity?
I certainly think getting and investing more and lending more into business to facilitate productivity improvements is a really good thing for the economy. And I certainly feel like there's an element of momentum around that particular agenda. Our business banking book grew 15% last year. Our institutional lending book grew 17%. Our mortgage book only grew 3%. Now, there's a very large number in the mortgage book, but nevertheless that highlights that there is a lot more growth and a lot more focus on investing in the private sector, and so that's a really important opportunity for us.
What are the absolute sizes of your mortgage book versus your business loan book?
The mortgage book we have today is approximately $518 billion of mortgages, and my business banking book and institutional lending book is approximately $235 billion.
Yeah, so
that'd be as of end of September 2025.
And then do you have a view how SME lending's growing? You said total businesses, but what about at the smaller end of the market?
So if we look at our business banking book, the SME, small to medium enterprise loan book grew 22% for us in financial year 25. It's a real area of focus for us. We've been really pleased with the growth there.
Great.
There's another segment which is called the small business, which is a much smaller revenue in that definition. That book pleasingly grew for the first time in 3 years in the last 12 months. So we're pleased to see and are starting to see some really positive developments in small business and SME in Australia at the moment.
Great. And maybe just one on notice, because the data I have is small business lending is flat for the economy over the last 10 years. So maybe you could have a look at sort of, has that grown over 10 years? And compare that to mortgages and just give us that on notice, if that's okay. Thank you, Chair.
Yep. Okay, over to you, Member for Wentworth, for 10 minutes.
A question related to this. What are the barriers for banks when they're to growing sort of business and particularly SME loans further, or investment in SMEs? What makes it harder to loan to business?
Look, I think first and foremost is understanding the client's business and understanding the risks inherent in that business. And so one of the observations for Westpac and one of the priorities I've had since I took over is that we need more bankers who are speaking to businesses and spending more time with businesses to understand what that business is and what are the risks in that business. So really understanding the risks inherent in the business is one of the key thresholds. I think also one of the areas that we've been very focused on is if we're the transactional bank partner to the business, i.e. they use us to hold their liquidity, receive payments, make payments, etc., it means that we're in a very privileged position in understanding their cash flow and the various impacts on that cash flow over time. And that puts us in a very good position to be able to go and lend money to that customer. And one of the initiatives we've had over the last couple of years is to look at all of the SME and small business customers that we have where they have their transactional bank account with us, so we can understand their financial performance. And we've been able to, if you will, identify the amount of financing we can provide them. And so we've now got essentially 60% of all the business banking customers with Westpac. We've been able to predetermine that we have the appetite and the capacity to lend them a certain amount each, and we are engaging with all of them in making sure they understand that we have capacity and have appetite to support them.
Are the responsible lending rules, or also the sort of capital demands, do those have an impact in terms of the amount of SME lending that you do?
So the capital, yes, is always about the assessment of the risk of the borrower, and so for many businesses they'll have collateral which they will provide, which helps us assess the risk and obviously reduces the risk if there's collateral that backs that particular business. And then for many businesses that don't have that collateral, we assess the risk and look at how we would provide them with finance. And that's been one of the areas that we've spent more time and effort on over the last couple of years. We started a fund which is for female entrepreneurs, which is a startup scale-up fund. And we originally thought it would be $500 million, and we looked to see how that would go. We've increased that to $1 billion. We now have $800 million deployed on that. And the performance of the scale-up part of that portfolio has been absolutely very pleasing and really giving us more encouragement now to expand that program to support more startups, more scale-ups across the marketplace.
Okay, cool. A question then sort of more onto scams in particular. There's obviously been the Scam Protection Framework, which is the legislation's gone through Parliament in February this year, but the sort of codes of conduct or those codes haven't yet been developed. My question is, have you been engaged at all with the government in relation to sort of draft codes? Is that something that you've been engaged in?
Yes, we have. We've worked very closely with government and want to acknowledge the fantastic efforts over the last couple of years in getting that scams legislation through Parliament. And we're now very actively working with the department in terms of the development of those codes. What we think is really important is that, and I think Australia is in a very good position here relative to almost any other country in the world, is that we're very much focused on going after this as an entire ecosystem. So banks in combination with telcos, in combination with the large media platforms, working in a coordinated way to ensure that we defeat this pretty horrendous scourge that is scams. And what's really important for us and what we're very focused on and working with government on is how those codes come together at the same time. It's very important that we continue to work as one team, one ecosystem to solve the particular challenge. And I'd sort of call out the fact that, almost half of all the investment scams that we're intercepting or navigating or dealing with have all come from, basically Facebook.
So when in those situations where you have seen those sorts of scams, sort of Facebook scams, what action is currently taken, with the social media company? What sort of information sharing currently happens in relation to try and stop customers having, once a customer's been victim to it, other customers not being victim to the same thing?
We do, when we've identified, a scam and, through engaging with the customer, recognise that they were entreated into the investment on an advertisement that they saw on, for example, Facebook. We do let the media platforms know about that. Fair to say that I'm not sure the response is always where you would like it to be, and so hence why we think it's really important that everyone has a code that they have to deliver on. And so what we find is, it's when the customer, for example, is saying, I'd like to transfer $100,000 into this particular opportunity, and we start to ask questions of them, you realise that actually they've taken the entreaty that they've got from the social media platform, and they're going to be scammed if we don't stop it. And so last year, we, through just simply asking through what we call our Safer Pay program, where we just ask a set of questions of customers, we stopped approximately $690 million of payments that would otherwise likely have been made. Now, it doesn't mean every single one of them was a scam, but nevertheless, they did not pass the test when the customer was challenged as to, well, do you really and should you really pass this money through? And so it just highlights we've got to have the media platforms actively participating in this. And the last thing I'd say, if you forgive me the moment to take a bit more time, you saw material recently sharing that Meta made $16 billion in advertising revenue, 16 billion Australian dollars in advertising revenue globally as a result of advertisements for what were effectively just scams.
And so, have you had the experiences in the last period of time where a customer's been scammed once, you've told a social media platform, and another customer has been victim to a similar scam or the same scam?
I'll have to come back to you with those. If there was, for example, we've identified a certain scam and that was the ad, and we've said, please take it down, and then later on another customer was suffered. I'll have to come back to you with that fact pattern.
Then just in terms of transparency of scam information, one thing I've as a customer would love to understand is how well my banks are doing in terms of preventing scams and also remediating scams if it is a sort of negligence on the bank's part. Is that something in terms of that openness, in terms of data? Is that something that Westpac would be open to?
Open to sharing with you, first of all of the work we're doing, all the money we're spending, all the resources that I've allocated to it, and also in sharing with you details of all the scams that we've intercepted and unfortunately the scams we haven't been able to catch or intercept before they were affected on our customers.
It's more about transparency for customers to be able to look at the banks on a scorecard or something and say, okay, Westpac's had this many scams and this percentage of their customers have scammed, and and versus CBA versus Macquarie versus others. Is that something that you would be open to?
I'd have to look at that. There's an inherent danger then because where the scams come from. The nature of the customer cohort, there's so many variables that feed into it. But what I would say is that Australia's scams are down year on year, and Australia's the only country in the world where scams have come down progressively over the last 3 years. And while we can't lay claim to all the credit, I think the way the banks have collectively gone after this, the way the regulators have worked with us in going after this, highlights that I think the Australian banks have done a very good job on this.
Taken seriously.
And I would say that we're very focused on how do we make sure the entire ecosystem is lined up to deal with this, because it's currently an arms race in how we beat this scourge. The resourcing, the nation states involved, the fact that they're now using AI, their sophistication, all means that it's just a never-ending challenge that's growing.
I see the challenge. I guess one question is, if a customer is subject to a scam, the bank realises actually there's a sort of bank negligence or bank role in that. Do you go and look at other customers who have been subject to the same scam and proactively say you might have, it's up to us to remediate that?
I'll definitely invite Ryan to add his thoughts on this, but to the extent that something has happened and we've made a mistake, we've not followed our process or not followed what should have been followed, we definitely then look at has that been repeated? Have there been other instances of that? So yes, we like to think that where we've made an error, we're challenging ourselves to read across and just make sure that it wasn't broader than that one instance.
Sure. Okay, thank you.
Remember, if we make a mistake, we fix it, and we fix it for our customers, and then we try to learn from our mistakes so that we don't make those same mistakes again. To your question with respect to typology of the scams, we do see the same type of scam continue to repeat itself. Unfortunately, many of the bad actors can reappear in slightly different form, but it's essentially the same actor perpetrating the same fraud against customers. And that's one of the areas where we need more help from the social media companies to try and stamp out some of that behavior, particularly in light of the enormous amounts of revenue that they get from advertising various scams and frauds on their networks.
Can I just, before I hand over to the member for Bennelong, just confirm in your evidence, you said that the platform with the greatest incidence of scams was Facebook? And that's
Meta Facebook.
Meta Facebook. Oh, so across all there. And that it was about 16 billion that might be of scams worldwide.
I'm drawing on material that was shared with me through the mainstream media where it was revealed in the United States that from source documents inside Meta, $10 billion of advertising revenue, and the advertisements were the promotion of scams.
Right, thank you. Okay, member for Bennelong, 10 minutes.
Thanks, Chair. Thanks, gentlemen, for coming today. I've got a few questions on payments, and thank you for your slides here. They're very useful. In their draft consultation paper, the RBA have focused on capping interchange, but seem to have gone pretty light on schemes and are almost silent on digital wallets. Does Westpac think there needs to be a bit more scrutiny on schemes and digital wallets as part of this review?
Yeah, we feel, and we do want to acknowledge that the process so far has been very inclusive and very consultative, and I want to acknowledge the Reserve Bank's been very actively listening and appreciate the extension that they've recently undertaken. We think it's really important that if you want to revisit or review the cost of payments in Australia, that you include every single participant in that ecosystem in the review. And so just at the moment, the very narrow focus on interchange as the way in which we would solve payment system costs in Australia is only but one component part, and we do think schemes should definitely be considered. Definitely consider digital wallets. We should also consider, international participants, the three-way schemes, which I know you're aware of. And so it's really about looking at it in its entirety, end to end, and then saying to the extent that we want to reduce a cost or a burden that we think is inappropriate, and again, for you to set the exam question, how do we therefore go about it? And I think that you can only do it if you have the entire system and every participant, if you will, being challenged to find a way to proportionally share how do we get to the right point.
To what extent do these scheme and digital wallet costs play in the payments ecosystem? Like, how does that impact what you charge merchants and how you go about your business?
And so, they're all part of the costs of providing acceptance to merchants, for example. And so, to the extent that there's a cost to run the merchants offering that we provide our customers, it's a component part that's built into that. And if those costs were lower than you would expect, that should mean...
Do you have a rough percentage of the cost of their impact on the end price?
There's a complexity to that calculation, sure. So I don't want to sort of dumb it down, but I'd love to come back on notice on that one and just give you the calculation so you can see how it also depends on the type of card used. It depends on...
because obviously interchange is... Happy to take that on note. Interchange is capped. But are scheme fees and digital wallet fees increasing, and have they increased over time?
Those other fees are not capped, and certainly those are negotiated in a commercial in confidence format. And so to the extent that they have not been, if you will, as constrained or have not reduced as you have seen interchange fees over the last 10 years.
And so has that put upward pressure on prices flowing through to merchants and therefore consumers?
I think it hasn't. It certainly hasn't helped. Yes.
Yeah.
So.
Have your scheme fees and digital wallet fees gone up?
We've been very focused. Well, those are confidential negotiations and arrangements we have. They haven't gone down. If I can maybe, sorry to be flippant or trite on that, it's not intending to be, but those are confidential matters. But fair to say they haven't gone down.
Whereas that same regulatory environment obviously doesn't exist for interchange because there's a capped environment for that. There's a lot more scrutiny on it.
I think that's a fair way to assess it, yes.
Do you think that same type of treatment should apply to other cost pressures within the payments ecosystem, like scheme fees, like digital wallet?
I think if we want to try and reduce the costs in the payment system, we also need to recognise that there's certain constraints in terms of how much lower costs can go, because there is a cost to run the payments platforms that we have. There is, and it's a reasonably significant cost in the context of Australia, given the reach and the infrastructure challenge. It's probably a little easier to be challenging for adjustments in, say, the UK, where it's a much more smaller market in geography, but a much denser population, and so there's a scale benefit there that we don't enjoy in this market.
RBA data shows that average merchant fees are up 10% in a year. Now that's the average. Do you have a figure for your customers that you provide merchant facilities?
So one thing that we just need to make sure we're talking apples with apples is fees will go up based on spending patterns, and so spending's up, then fees will go up naturally. In the context of the fee we charge our customers, we have not increased our fees. We've been very focused on providing as competitive fee as we possibly can alongside the package of services that we want to provide to our merchants.
Right. The RBA have just proposed sort of transparency around scheme fees in their draft. Given you've basically got a duopoly there, do you think that'll help that is enough to put downward pressure on some of those fees?
I think transparency is a good thing. Whether there's a causal link between that transparency and the outcome that people want to see, not proved, but nevertheless, I don't disagree that transparency is obviously a really important threshold to ensure that competition and ensure the outcomes that people want is realised.
Right. You touched on in your opening statement and your latest submission that the RBA reform only targets Australian payment operators. I guess I just want to understand, if that reform were to go through as is, what would that mean? If only Australian operators were targeted, what would that mean for the industry? What would that mean for small businesses and consumers in terms of the costs that they have to incur?
So if the reforms went through as we see them today, then I look at one precedent, which is the UK. There was no reduction in the cost of acceptance for small business merchants in the UK. And so that one of the stated desires or goals, which was to reduce the burden on small business and merchants, wasn't realised in that market, where they just simply lowered interchange fees. So I would expect that naturally would follow here. I think you'd also, and again, now that the Reserve Bank has the power under the Payment Systems Regulation Act to regulate some of the international participants, such as the digital wallet participants, such as the three-way schemes like American Express. The question is, if they do exercise, and if they don't exercise that regulation, then essentially a lot more will migrate to those particular participants, and that money will be collected. And I think I've heard and people describe the lack of tax paid by international participants in the marketplace here that likely naturally follows.
Just popping on your website, you seem to have all your cards are branded MasterCard, so you've got a commercial arrangement with them, I would imagine. But you provide other cards as well, or just?
So we have a part of the banking portfolio we have is with MasterCard,
yep,
and part of it is with the Visa. So, okay, for example, some of our non-Westpac brands have Visa partnership. We also work with Visa in our Pacific operations, okay, and so it's a little bit of a package of partnerships we have across both Visa and MasterCard.
And when you reach certain turnover or cards issued or stuff like that, do you get paid a rebate on that?
We all, it's an industry practice that level of spend, level of activity does drive improved economics for the bank, the issuing bank,
okay,
in that particular arrangement.
And the costs you incur from the schemes, do you pass that on as charged or net of the rebate?
I suppose the way we cost the business and how we deliver the service to our customers includes the rebate, and it just includes what is the cost for us to provide that card, okay, and provide that to our customer, and what is the return we get on that. Does factor in whether the cost we incur to run, yeah, as well as any other financial incentive that attaches to the provision of that particular service to the customer.
Okay. I've got no further questions, Chair.
Tremendous. Well done. I'll now hand over to the member for Moreton, who's coming to us from Brisbane. What did I say? I did it again. Seriously. I'm just...
Trolling. That's all right. I am overlooking the beautiful Moreton Bay, so it is fitting.
2 for 2.
Thank you very much, Chair. And Mr. Miller, I've got a few topics I want to touch on, but I might just start with the comments that were made in the Australian yesterday in relation to Westpac being ready to bankroll critical minerals and willing to take on more exposure to gas. Obviously, in Australia's context, we're looking to critical minerals and gas as a major area for the transition. Do you feel that the current ESG rules that you've got are constraining lending to these sectors?
So the current targets we've set ourselves and the policies we have don't constrain us in supporting critical mineral opportunities, financing of those opportunities, no. And we are working actively with customers, government regulators on a range of opportunities in Australia. I think it's a very exciting development for the country. Equally, our commitment and participation in relation to gas financing is that gas is a critical component of the transition that needs to be undertaken. And so to the extent that it's consistent with the pathway we're following and the pathway that's been adopted by the country, then we will continue to support gas. But it's part of how it contributes to the transition as opposed to some sort of commitment or focus on expanding what we do with the gas sector in Australia.
And what exactly would you like to see then from the government or from the parliament to facilitate you to be able to, increase your lending to support gas projects like your comments in the paper yesterday? What exactly are you looking for the government to do?
Well, I think the country has a plan to transition, and so we will be financing and supporting that transition. So I don't seek, and nor am I soliciting, incremental support or endorsement or other action. The country has a plan to transition, and to the extent that gas has a role in that transition, we will support gas as part of that transition.
I want to ask about the Net Zero Banking Alliance, which Westpac was part of, but has sort of ceased to operate last month after a lot of other global banks sort of pulled out of it. Do you think that the ESG policies that it was putting forward has caused your bank to decline or restrict otherwise creditworthy Australian projects?
The NZBA has moved from a sort of a membership compliance organisation to an advisory framework, organisation and sharing, what's best practices, etc. But I certainly never felt that our transition plan, our transition commitment meant that we were not supporting those that needed to be supported in the context of delivering the transition outcome for Australia.
But you would say that Westpac would potentially have assessed different projects over the course of recent years, fossil fuel projects, coal, gas, etc. That would have been has only been declined due to your ESG framework?
No, I don't think it can be characterised that we said no due to our ESG framework. When we look at opportunities, clearly our policy position, and you can use the term ESG, but our policy position is part of the assessment. There's obviously a detailed analysis around the risk. There's also detailed analysis about the shape of our portfolio, and there's also detailed analysis around the customer, and is that customer one that we believe is a long-term partner that we want to be involved with. So it's never one thing, it's a package of things that need to be weighed up in deciding whether we would support that customer or that particular opportunity.
Okay. I want to ask about productivity. We know, of course, that RBA's brought down their growth assumptions. Treasury is assuming a little bit higher than that, but still not brilliant. It's obviously a topic that we are debating and have a keen interest in across the Parliament. I'm keen to know what Westpac's house view is on Australia's productivity trajectory and how that is shaping your lending and risk settings.
So we're forecasting sort of GDP growth next year of about 2.4%. And I think there's a lot of signals to suggest that actually it could be a bit more positive than that. And what about
productivity growth?
I'll have to come back to you in terms of, there's a number of different ways you might sort of describe productivity growth. But I think first things first, which is we have growth in the economy. And I think what's really important is that at last the growth in the economy and the level of activity and investment in the economy is increasingly being undertaken by the private sector, effectively taking over the lead running that has been undertaken by the public sector for the last few years, which was a necessary and entirely appropriate position for the country to be in as we came out of COVID and wanted to get the country moving again. But pleasingly, the growth and demonstrated by the growth in our loan book in business and institutional last year of 15% and 17% respectively, just highlights that the private sector is now much more active, and we're confident that we'll see that continue through the course of the next 12 months. In fact, I'd sort of call out that the growth we've seen only in the last 2 months since we finished our financial year in September has been very encouraging and already ahead of what we thought would be the growth we'd see in 26. So that's, again, highlighting that I think there's a lot more green shoots in the economy that we can be very pleased about and encouraged by. And I certainly think, though, the recent commencement of a proper public discussion and engagement around how do we improve productivity in Australia is really important, because that is one of the unlocks for us in taking some of this growth and taking some of this investment cycle and really improving, if you will, the lifestyle and opportunity for all Australians.
But are you seeing that increased investment? Are you seeing it into areas that will increase, the productivity of your clients? I'd be keen to get some insights from you across your books. What are the general sense that I'm getting is that local businesses in my electorate, for instance, are primarily doing things on the short term on the basis of trying to survive as opposed to actually investing in their long-term growth. Is that the sense that you're getting across all your books?
Yeah, I'd acknowledge that in relation to small business, lesser extent SME in the last 6 to 12 months, but certainly in small business, it's been an environment where they're just navigating. They're not, if you will, investing in their businesses. It's been all about safely getting through the setting that they've had to endure. And so, yes, I agree with those comments in relation to small business. In the bigger end of our book in Business Bank, where we saw very significant lending growth in business banking of 15%, in the larger end of the small to medium enterprises, they are borrowing to invest in new equipment. They are borrowing to invest in new processes, and they are borrowing to invest in lifting the performance and productivity of their business. So we are encouraged by that. And obviously that's one of the things that we do look at when we look at financing for businesses is, what's the debt being used for? And use of debt is a really important characterisation of the risk that we're undertaking. And that's why we grew as much as we did, and that's why we were prepared to grow as we did, was because the use of proceeds was very encouraging in terms of what they were deploying on. In the institutional end, even more so, I think there's a significant focus on investing in new technology, investing in new processes and automation to drive productivity. And so I would call out that we're pretty encouraged again by the amount of debt that's been drawn down from us to fund that kind of activity.
How am I going for time, Chair?
I reckon you've got one more question in you.
Okay, very good. Across your SME and commercial portfolios, have you recorded an increase in your customers who are seeking assistance or restructuring or hardship support specifically due to rising energy costs?
We've certainly seen across the book over the course of the last 24 months a decline in stress levels, a decline in delinquencies, a decline in defaults. And so to the extent that there may have been instances where companies or our customers were struggling due to energy prices, that's probably a component part of that. But the overall books have all, if you will, improved, and all the indicators are very encouraging in terms of the reduction in delinquencies, the reductions in defaults, the reduction in stress across our book. I'm not sure, Ryan, is there anything else you...
As Anthony pointed out, we have seen pleasing improved performance across that sector of the book. However, obviously, those sectors that are energy intense in terms of manufacturing, anything that is a larger component of your cost base, if that price is going up, they will feel some stress, but it has been idiosyncratic at best in nature.
Thank you. So I'm going to go to the member for Reid and the member for Casey. Member for Reid, 10 minutes.
Thanks, Chair.
No worries.
I'd just like to go back to the role of Westpac in the clean energy transition and decarbonisation of our economy. What is the bank's approach to net zero, and what are some of the commitments that you've made?
So we've made a commitment to net zero by 2050. The way we've set targets for the company in terms of our own emissions have been very much focused on delivering on that agenda. And then in terms of our support for the transition is focusing on how do we finance businesses in Australia on their own commitments to deliver to net zero 2050. And so we're very actively making sure that in our day in, day out operations we are making our own contribution and importantly providing finance and support to our customers who are also very focused on delivering on their transition. And various customers are at various stages of success on that and various levels of sophistication. We continue to challenge ourselves to we've got to stick by people. We've got to try to work with everyone to get to where we need to get to on the transition. And so there are instances where I think people would say, gee, are they making enough progress? And we'd say we need them to make more progress, but we've got to stick by them. We've got to continue to challenge them and make sure we help our customers get to where they need to get to on the transition.
And if I could ask you a question on notice around the growth that you are seeing in investments in clean energy projects and some of the trends that you're seeing as well. But more directly, what's your stance on providing financing for new coal-fired power plants?
So we, let me just back that up a little bit. And so first of all, we now have no exposure to thermal coal mining in Australia, or anywhere for that matter. We are actively working with those customers who have coal-powered power stations, working actively with them in terms of the transition. 89% of all the money that we lend to power generation in Australia goes to renewables. And so we're the largest renewable financier in the marketplace. And so we're working with our customers and can reflect on senior executives at our customers who have some of those assets, and their focus on continuing to work to replace those coal-powered stations with the right combination of renewable, battery and other solutions to ensure that they transition. And so we're very committed to supporting them on that journey.
What has led to that 89% investment in renewables? What was it that drove that investment?
Well, I think the commitment of the country, the commitment of businesses, and the economy itself around transition gives you the confidence that that particular project will stand up, will survive, and has the necessary commercial, meets the commercial parameters. And so we felt that it was an attractive and important business opportunity, as well as being very aligned with the overall ambitions for the country.
Do you think there is anything that jeopardises that confidence in investment in renewables? Does that require a bipartisan whole-of-parliament approach?
I think the regulatory environment in which we're operating has given people a lot of confidence for a considerable period of time. I think one of the things that we need to definitely take ownership of as a community, banking system, the renewable power, energy, and frankly everybody, is that some of the processes for approval are taking longer than might be healthy, and that's obviously getting in the way of the transition and the pace at which the current settings are in terms of the pace at which we want to transition are somewhat at risk if we don't see faster approvals and more projects moving to deliver and ensure the country gets to its target state.
Do you get a sense of the scale of the investment in the renewable space? What is it that some of the projects that most excites you that you are now financing and backing?
Look, we're very supportive of some of the initiatives the New South Wales government has undertaken in terms of special regions, renewable energy regions, which you've got a designated area where the renewable resources will be based, and then it's about making sure the grid is appropriately upgraded so that the power's then, if you will, delivered back to where it's used, which is in the cities. I think that's really encouraging because that's very thoughtful, detailed, long-range planning that gives you the confidence to invest, and investors are actively participating, and then obviously for us to finance. I would say that in many ways, the discussion around the transition is one that sometimes seems to be consumed by negativity and dogma and worries, whereas in many ways, the transition is one of those potentially significant moments for the country. If we can transition and reach a certain emissions responsible power generation capacity provided it's reliable and dependable, and provided it's cost effective. If we look at it, that is a wonderful opportunity for the country. It puts us in a very unique position, I think, and so therefore, I'd really like to see it much more of a nation-building opportunity of a lifetime, and have everyone line up around that. Which, as I say, means we want to deliver the transition. It cannot be at the cost of dependability and reliability, and it should not be such that the power price is more expensive going forward. And I think that's well within reach for the country if we go for it.
Yes, I agree with your assessment about this being a big nation-building opportunity. I just wanted to quickly turn to scams with a few minutes that I've got left. Oftentimes, there's a lot of focus on the customer whose money is, I suppose, leaving, the person who's being fleeced. I wanted to ask you about what you are doing as an institution to prevent customers wittingly or unwittingly being the source of the scams coming in, receiving the scams, and then that money kind of fleeing off. I guess like a mule account. What are the steps that Westpac is taking to ensure that that's not happening?
So thank you. That's a really great question, and one of the key challenges for us. And I'll invite Ryan to add his thoughts and reflections on that. But every bank account is day one opened in a legal, legitimate way, and mule accounts are inevitably due to someone stole the ID for that account, or it was sold. Or alternatively, the owner of the account is complicit or a victim in the particular scam or situation. And so they're very hard to identify. And one of the important challenges for us is that a major source of mule accounts is bank accounts that have been literally just bought by somebody. And as it stands today, if you go on to, dare I say it, Facebook and look up bank accounts for sale, you'll see bank accounts for sale, and you'll have the bank's names and the cost of that bank account. So that's an illegal activity, yet it's allowed to prosper. And that bank account then gets sold, and as a result, we don't, there's no change in its characterisation. It's just now owned by a criminal. And then as a result, the scam is able to be affected on unwitting customers. And so it only reinforces this, and I think Australia's done a really good job on this, but it's a real opportunity again for us to be a global leader, is to make sure this has got to be solved as an ecosystem, and all the participants have got to be involved in this. And so, for example, you should not be allowed to advertise the sale of bank accounts, and that's illegal. Yet it does occur. And unless everyone in the ecosystem and those who advertise bank accounts are involved and take ownership of this, we're not going to be able to deal with it as comprehensively as we would like.
As Anthony mentioned, the notion of being able to go onto something like Facebook and just say buy a bank account and finding pages and pages of information on how to buy a bank account illegally online is something that we have to stamp out. It presents too much risk to everyday Australians. What we're trying to do about it is we've increased our detection capability. We do transaction surveillance on all inbound payments. There is better interbank cooperation around identifying mule accounts and sharing information so that we can work together to stamp out the mule accounts. And we have a number of onboarding controls, including behavioral and facial biometrics, to try and make sure that the customer is indeed the customer. But at the end of the day, this is a financial crime perpetrated against Australians, and we have to find the people who perpetrate and who profit from the financial crime and stamp that out.
Okay. Terrific. Thanks. Member for Casey.
Thank you, Chair. Mr Miller, does Westpac finance green hydrogen projects?
We have looked at a number of green hydrogen projects. If I could just take on notice if there's anything in particular that we've just done.
Yep.
But certainly we have not committed to any large green hydrogen projects, any financing. We may have committed to provide some support in the future, but we've also just acknowledged that green hydrogen projects and their economic commercial viability is still to be proved, I think, to a level that gives us the confidence to support them.
So it doesn't stack up commercially in the current environment. Thank you. Now, just on interest rates, Mr Kennedy asked about the coming 12 months, and you said from Hansard, our official forecast is there will likely 2 rate cuts next year in May and August. And then the follow-up, you mentioned that you'd forecast one for November, which obviously didn't happen.
Sorry.
Yeah, and so my question is, given you'd forecast November, May and August, and clearly the November forecast was incorrect, are you adjusting your forecast for next year? Have you done it since the November RBA decision?
I need to be very fair. My chief economist is an outstanding economist, Lucy, and so she revised her forecast essentially the fortnight before the November Reserve Bank meeting, off the back of the inflation number that was printed. And as she revised her forecast for the November board meeting, she retained her forecast in relation to 2 further rate cuts in May and August of 2026, but are clearly data dependent. And so provided we saw what we think we're seeing, which is that reduction in inflation to the target setting for the Reserve Bank, then we would anticipate that there'd be a rate cut in May and August next year.
I'm keen to understand why there was no change, given we had the CEO of Commonwealth Bank, I understand a separate organisation, this morning say that they were now forecasting no rate cuts. And given the November number will be carried forward for 12 months, so will materially impact that, I'm trying to understand why there would be no change to the forecast, given that material change and given the Commonwealth Bank CEO has said they've changed their forecast.
So hence, very good question. Our chief economist, who I think is outstanding, she revised her forecast for rates close to the November meeting and retained her forecast that she still expected a rate cut in May and August next year, but it depended upon certain underlying trends continuing at the pace that needed to be to deliver the trimmed mean inflation number, which is a critical, I suppose, indicator of where the Reserve Bank might likely be.
So the forecast was 2 weeks before the November rate cut, and it hasn't been adjusted since? Sorry, since the November decision, not rate cut, November decision.
Again, subject to if anything's come out in the last 24 hours.
Yep.
Her forecasts were within the fortnight leading up to the Reserve Bank decision of no reduction. She affirmed her view that while there wouldn't be a rate cut in November, she still expected, based on what we're seeing, 2 rate cuts next May and August, data dependent.
You've given there's actual data in November, which again is 12 months, and given customers look at, rate cuts and potential rate cut forecasts in how they take out loans, et cetera, would you anticipate or would you like your chief economist to review those 2 numbers?
It's really important for me that there's a clear level of independence for Lucy. She is our chief economist. I think she's brilliant, and she does her work, and she makes her calls independent of any thoughts or ideas that I might have.
Okay, just want to move across to payments. Just want to refer to the Prime Minister's press release on the 15th of October 2024, where he stood and said, and I quote, "We are prepared to ban debit card surcharging from the 1st of January 2026, and then added a little rider afterwards, subject to consultation. Is it your anticipation that there will not be a ban to debit card surcharging from the 1st of January 2026?
I think there's been pretty broad-based acceptance of the need to, or support to, remove the ability to surcharge debit card at very least. And then I think, the extension of this review process to really exhaustively and thoroughly determine should more be done. I would just have to, I suppose, take on notice or check for you as to whether that 1 January commitment is not able to be met because the process of engagement that was committed to, and to be fair to the Reserve Bank, they've been fantastic on this, is going to be a little bit more thorough and comprehensive, which we think is really important because we do want to see the entire system reviewed holistically.
So, given it's the 18th of November, we're 8 weeks out from that date, you've been given no indication of when the surcharging would likely start then?
Yeah, I'll have to check if there's anything that's saying it's 1 January is a hard stop date. I think Ryan and I will have to check for you. But my understanding is because we've extended, or the Reserve Bank Governor and the Reserve Bank team has extended that review, it might take a few more months to get to that point.
Industry insiders are part of the payments ecosystem when this announcement was made in October 2024 said to me privately that this was a headline and it wouldn't be delivered. Do you share that view? That it wouldn't be delivered by the 1st of January 2026. It was impossible for it to be done by then and it was a pure headline by the Prime Minister. Would you agree with that view?
I'm obviously not privy to those conversations, and I've not had conversations with banks, participants in the payment system that had any such cynical view on that. I think what I would acknowledge, though, is a process is underway, a review is underway, and I just want to commend the Reserve Bank for agreeing to do more work to really sort of get to the bottom of what's the right outcome for Australia.
Perfect. Thank you. And on another topic, do Westpac plan on negotiating a Pacific banking guarantee with the government, similar to ANZ's guarantee for their Pacific operations?
We've committed to stay in the Pacific, and we're honoured to do that because we were banking and have been banking in the region for well over 100 years, in both Fiji and PNG in particular. We see it as a responsibility to Australia that we continue to bank those two markets and bank them well. And I would just want to acknowledge that the government has been tremendous in terms of supporting us on making sure we stay active in those countries to protect Australia's interests, given the current global setting that we're in the middle of. As to specific partnership arrangements, etc., we're comfortable with where we are today, and we continue to discuss with the government what's potentially needed to make sure we can bank PNG and Fiji safely. So there's nothing specific needed from us at the moment.
Chair, I just want to check how we're looking for time.
You've got 2 more minutes.
2 more minutes. Okay, so just wanted to jump across to hurdles on customers to earn interest on their deposits. And given the time, I might give you a list of questions that I'm happy for you to take on notice, but just want to reference the ACCC inquiry found that 71% of bonus interest accounts did not receive the bonus interest rate on average each month over the first 6 months of 2023. So I've just got a list of 8 questions that I'll read out for Hansard and take those on notice. And if you want to add a minute or two of commentary just to manage the chair's time.
The other thing is too, you can just put them all out without reading them.
Well, just do that.
And if there are any particular questions you want to ask, you can certainly use the remaining time to do so.
Yep, so I will put those 8 questions on notice. I just might start with how many hurdles do customers need to meet to gain their interest as part of your interest accounts?
So there's one reward product that is the key offering we have, and it's about making sure that the amount in your bank account is at least $1 more per month. To the extent that it's up by $1, then you qualify for the bonus interest rate. I would say that by value, 85% of the deposits that are with Westpac under that particular product are getting the bonus rate.
Perfect. Thanks. I'll leave the rest of those. Chair,
tremendous. Okay, well done. I'll now suspend proceedings for a 15-minute break, so we'll start again at 3:25. Well done, Mr Miller. You managed to draw members of the public in as well. They were here for a period of time. They were here for a short space, though. That one group left relatively early and the other endured. So, not because of you, because of us.
Thank you, Chair.
If everyone's ready, broadcasting ready, terrific, thumbs up, that's great to see. Okay, so member for Bowman, Morton, over to you for 10 minutes.
Well, thank you very much, Chair, and thank you both for giving evidence today. I presume that you are aware, particularly if you'd watched the first session of evidence this morning, of ASIC's concerns surrounding potential issues with the operation of offset accounts not functioning as they were intended to, and referenced in their strategic plan. I was going to ask, when you became aware of that, did Westpac take any steps to investigate whether your own offset accounts had been functioning properly?
Well, thanks for the question, and I'll certainly ask Ryan to jump in as well. But yes, as soon as we saw that announcement, we asked ourselves, is there something we're missing? Are we getting something wrong? So we have and continue to go back and say, is there something we're missing here? What's not working? We feel confident that we've got it right, but equally, ASIC's now soliciting and getting information from us. So, we're working with them to make sure that they have everything they need. We've been pleasantly surprised in many ways by the growth in offset accounts this year, and it's been an important contributor to the growth in deposits across the bank over the last 12 months.
Thank you. And what did those investigations uncover in terms of the operation of the offset accounts?
Well, they uncovered that we are confident we're getting it right, but hence waiting for, and working with the regulator on that. One of the things that I would say is that this year, it was approximately in sort of March this year, we were able to provide all of the customers of Westpac Bank, so we have Westpac St George and other brand names, but the Westpac Bank, we could offer all of our customers multiple offset accounts. Traditionally it was just one, but we're now offered multiple. And obviously in the work in getting that right, it's only in the last 12 months that we've done a lot of work around offset accounts within the bank to get that uplift delivered. So I'm hopeful that uplift meant that we're meeting the standard we need to meet in delivering offset services to our customers.
So for clarity, no challenges in terms of the offset actually applying to remove the interest?
Nothing that's been brought to my attention. The work's ongoing. Ryan, if you'd like to add.
The work is ongoing. We're cooperating with the ASIC investigation. Obviously, there's $73 billion worth of offset accounts at Westpac. There are a huge number of them, but we are looking across the protocols, making sure that we got it right. There would be a number of instances or reasons why customers may not have activated offset accounts. And obviously, if we find that we have any error resulting from inaction or the wrong action on our part, we will stare in and look to remediate that.
No, thank you. And when you became aware of that, and as you've undertaken the process to look into the offset accounts, did you advise frontline staff or mortgage brokers or financial advisors and brief them about that process?
Yes, we in order to get it right, we'll have to share our learnings with everybody who's part of that ecosystem.
Okay, so
sorry, we'll have
to. Yeah,
Yeah, you go.
Sorry, so that hasn't been done yet, but you intend to do that shortly?
We would intend to do that once we get through the investigation and identify any particular errors that may have occurred with offset accounts.
So you're still in the process of doing the investigation?
The work is underway. We haven't found anything, but equally we've just got to keep exploring and digging, and equally we're working with ASIC on that.
No, I understand. And in terms of any potential issues that might happen in that offset space, do you see it as the onus being on the customer or the bank?
Well, I think the way we'd approach that is if we've made a commitment or we've offered and failed to honour that commitment or failed to follow up that offer in the way in which we've put it to the customer, then that sits with us. If it's the case that the customer has not done something or did not do something correctly, you would argue, should the burden sit with us? At the same time, did we make it absolutely clear, and do we do everything you should expect of us to make sure that the customer could and should have done what it needed to do? And if it's the case that we found ourselves not at the standard we think we should be at on that, then we'd obviously look to be accountable for that. So it's really just working through and making sure we understood, did we do what we committed to do? Did we deliver the service we said we deliver? And have we ensured that the customer knew what they're doing and knew what they had to do to avail themselves of the offset? And just continue to work through that.
And so if any issues do come up through that investigation process, what will be the steps that you take from there?
So I think, and again, I'd invite Ryan to sort of jump in, but as soon as, if we identify that we didn't get it right, the immediate reaction is, okay, is that unique? Is that once only? Let's now look at that fact pattern and let's read across that cohort of customers or that part of the bank and how it was engaging with customers and say, is this more than one instance? And then, of course, if we identify that it's more than one instance, then obviously that requires us to go further and deeper and we keep going. If it's the case that we made a mistake, then the idea in the discipline is, where did we do wrong? What, therefore, is the outcome for the customer? What do we need to remediate the customer? What do we need to do for the customer? And then, of course, if it's a breach of any obligation, regulation or otherwise, do I need to also report that to the regulator? And should I post the regulator on what's gone on here? So it catalyses an immediate amount of action and inquiry and diligence.
We already talked a little bit about AI today, but I wanted to ask about...
Can I just
yes,
jump in very quickly?
Of course you may.
Just in relation to the questioning from the member for Moreton, in response you said, you said something that there's a bit of a thread in the breeze we need to clarify. You said, effectively, if something didn't meet expectation, you use the phrase, this sits with us. But it's a bit, from my point of view, unclear what that means. How do you see, when you say it sits with us, does this trigger follow-up action to assist the customer and give effect to some sort of financial recompense?
And so, yes, so the inquiry is something has not gone right. Let's say we identify something. Is that because we just didn't do what we said we do? Clearly that falls to us. If it's the case that, for example, we identify that a customer...
no, but when sorry to interrupt, when you say it falls to us, then what does that trigger?
It falls to us to then engage with the customer and say, we got this wrong. As a result, this is the financial impact that we've identified for you. Here's how we respond to that. Here's the compensation, and we follow the processes and policies.
I just thought it was important to clarify that.
Okay.
Sorry to interrupt.
No, not at all. Thank you.
You're comfortable?
I was going to move on to AI and its impact on the workforce. So specifically, I was going to ask, how are you using AI in terms of what roles, and how do you see that impacting on the workforce?
So thanks for the question. This is a question we're all working with all the time. The way we look at AI is that it's an exceptional tool. There's a lot of hype as well. I want to be cautious about some of what people are forecasting, but nevertheless, it's a tool, and I think its potential impact on how we work, how we deliver services to our customers, I think is going to be quite profound over time. But it's fundamentally a tool. And so the way we're looking at it is, how do we therefore equip our people? How do we invest in our people? How do we train our people to be able to use this tool? So that's sort of, in particular, point number one. What we've also focused on is, let's get this tool in the hands of as many people as we can. So we have over 15,000 people inside Westpac at this point who have access to the Microsoft Copilot AI tool, and they're using it, they're, if you will, practicing how to use it, they're learning how to use it, and we're immersing the company more and more in this tool. The next chapter for us and next stage for us is then to start to look at what more can we do, what incremental investment, what other AI capability do we need to introduce so that people can do more, can do their job easier, they can do it safer, they can do it faster. Where we're seeing real success in the use of AI in the company at this point is where it helps our employees do their job better, more consistently, sometimes faster, and importantly, in a more safer, consistent way, which is of real value. And an example I'd share with you is we have built a generative AI tool that works with our customers when they take a call in the scam centre. When the call comes in, customers are inevitably very concerned about they could have been scammed. There's emotion, There's a lot of jargon, and there could be language barriers, etc. And so how do we make sure that as quickly as possible on our call we get to the key points of what's gone on or may be about to go on, so that we can then action some action? And the generative AI tool listens to the call, and as the caller is talking and using language and different words, calling out, no, this looks like for example, a scam consistent with a pattern we've seen elsewhere. You should check, have they done this or have they done that? And it helps our call centre operator quickly get to the key points to ensure that the customer, we understand exactly what's gone on. And then we can more quickly and effectively action anything if we can. And the outcome of that is we get through the call quicker, we get through the call more safely, and more importantly, we do it consistently, so there's the right standard, and the employee has a tool which makes sure that they can do that quicker, more consistently to the right standard. And so that's been we've been really positive about what we're getting out of it.
So understanding your response, that means that Westpac's position is that AI would never replace a job. It would merely enhance a job that's being done?
The way we're employing it and the way we see it working is very much a way of making the job of our employees easier, safer, faster, and more importantly, enable them to get it done to a more satisfactory or more consistent standard. Some of the things that we do like about what it's doing is it enables them to get through some of the more mundane, laborious tasks quicker, allowing them to spend more time then on perhaps the more satisfying aspect of their role. And so another example of that kind of thinking is the Mortgage Assist generative AI tool that we have. And as someone is assessing a mortgage application, they need to synthesise a whole host of policies, responsible lending obligations, regulations, etc. And they're able to use that tool to quickly get through the material that's in front of them and get to the key questions or points that have to be answered.
No, thank you. And is it Westpac's position that AI would never replace a job?
I don't think we can talk in absolutes that it won't replace a job. What we've noticed, for example, in that example I shared with you, is that we're able to, scams are growing, but we are able to accommodate more scam calls with our existing workforce because the tool helps them be more efficient and deliver a more effective outcome. And so it's meaning I don't have to put more people on in the scams call centre to solve for the work volume. So it's in avoiding the need to put on more roles is at least that example there. But it's important that we don't hold ourselves to that situation where we say it won't replace any roles. I think it's a technology, it's a tool that we're learning how to use, and I think its ultimate end state is it's unclear on what its full capability will be and what it does mean for the workforce. But it's no different to, for example, the challenges we've had in the past where we started to digitise and automate how we provide services and products to our customers. And no one, and everyone expected there would be job reductions as a result of that, but no one in the forecast of what would follow from that realised that I'd have to put 500 people on to deal with scams, which are directly linked to the digitisation of banking services. So I think the type of roles will change, and AA may replace some roles, but the workforce will evolve as we have seen with the digitisation program.
Understand. I was going to say, what specific human oversight is there to ensure the safety of customers when it comes to the application of AI?
So we're very focused, and I'll invite Ryan to add his comments on this. That is, it's a tool, and we have to be there for. We're accountable for this tool, and so we can't not make sure that in using this tool to deliver a product or service that the human is accountable for it, and the bank is accountable for it, and so there's no hiding that. And so therefore, we're very focused on how do we make sure this is a tool used by our people to improve and deliver a better service for our customers. If I go back to that scams example, what happens is all of those calls are, if you will, recorded, but more importantly, because of the generative AI tool and because of the real-time capability of that tool, we're also able, in a real-time sense, audit that call and make sure we met that standard. So it's the case that it isn't replacing the human in that matter, in that circumstance, but it is also the case that it is not able to be used unless a human is using it, and the human makes sure we get to the right point. So we do think a human in the loop, I think there's other terminology people use, but it's a tool, and it is therefore a tool in the hands of our people, and they're accountable for it.
Thank you.
Tremendous. Sorry, Mr. Zanin, I might ask you to just defer answering. I'll ask some questions on AI and you can jump in then if that's okay. I might hand to the member for Deakin for his 10 minutes and then to the member for Brisbane.
Thank you very much, Chair. Noting the measures you've announced relating to regional banking, I was just wondering how your bank is working with others in the banking sector to develop longer-term solutions to regional banking. So, for example, the pub owner can get their 50k in float and the local businesses can get loans and things like that. Are you working collaboratively with other banks at the moment?
We're certainly looking to work collaboratively in solving. We have to be careful in terms of working with other banks given competition law and other issues, so we have to be very sensitive to that. What we are working on in, for example, regional towns is the way we will offer those services which cannot be delivered by Bank at Post. And so Bank at Post provides a wonderful service to regional Australia and makes a real contribution to giving basic banking services to citizens in regional areas. And how is it, and hence the announcement of that community banking program, how is it that I complement that by making sure all the things that Bank at Post cannot do for a customer, that I have someone in that town on a regular basis meeting with customers to make sure that we do those things that are not being done. And so that's part of the trial, part of the pilot program is to work out how we get that combination right.
So using the example I gave of the $50,000 float for the pub owner or RSL, would the regional banking model you've announced actually assist with that?
So the way we look at cash and cash distribution is another layer of complexity in the services in regional Australia. And part of the trial will be, is there something we need to do better in those towns where we don't have a full-time physical point of presence and I have a visiting bank team? Is there something that we need to do incremental to what they currently have in place in terms of how they manage their cash and their cash flow day to day? So the idea is that we engage and we'll see if there's things that we can do and learn to do better in those particular settings.
So does the extension of the moratorium suggest that you don't anticipate the industry figuring it out before 2030?
The extension of the moratorium is because I just wanted to affirm to everyone we're very committed to supporting regional Australia. We know that was an important message, that there was that moratorium on closures, and so we've given that commitment. And then now it's just working as hard as we can to do the following, which is how do I deliver the service that customers want in the format they want and where they want. 96% of what they're doing with us is digital. And so only 3% is in effectively a branch or a person-to-person setting, and 1% is virtual. And so how do I deliver that combination into regional Australia? And so what we've decided and what we're focused on is how do we just keep working at getting that combination right. And I'd acknowledge that we reopened our point of presence in Moree 2 months ago, announced that about 6 months ago, and that's been a real success and a real healthy reminder to me and to the team about the point of presence alongside the digital, alongside the virtual, is how we must think about delivering service into regional Australia.
I'm going to jump around topics a little bit due to the lack of time. There are claims out there that the reduction in interchange would lead to reductions in reward schemes. I was just wondering if you could share how these schemes are currently funded and whether it really, does this leave small business and consumers who are using debit cards and the like paying for what are effectively incentives to attract high-value customers?
Yeah, so I'll try to sort of go through that, and if I don't get each of the points, please course correct me. Where interchange fees were just bluntly reduced, there was a consequent reduction in the offering, and this is in the markets that we've observed, and we shared this in our submission. But fees on all cards went up. The interest rates on all cards went up. The no interest-free periods all went down. and rewards also went down. And so that is the direct causal link between just a reduction in interchange fees and what happens in the market where this has been done. And so our submission and our concern is that just a simple focus on the reduction in interchange fee on its own could lead to those kind of consequences. And so, yes, it could be, and I think it would naturally follow that rewards programs, which are used by many Australians, would potentially be adjusted, or
So are
there
they
would be
funded by the
increase.
interchange presently?
Interchange is, yes, part of the economics within the, if you will, the payments and cards industry that funds, the delivery of services, and in delivery of services that many people want on cards includes rewards. The thing that I would just want to emphasise is that we have 2.2 million card holders at Westpac. 1.4 million of those card holders have no reward program. What they want is no fees, or a very low interest rate, or a long interest-free period, and that is what the interchange and the economics in the payment system today currently provide them. And if you therefore change the interchange fee, then you will see, for people who see this as a working capital tool in the month-to-month and week-to-week paycheck situation, they see it as a working capital tool, you'll see potentially fees, potentially interest rates go up considerably for those card users.
But these schemes are a promotion, aren't they? They're there to incentivise you picking a credit card, primarily high-value customers, so you get that business. It's an incentive to use credit cards vis-a-vis a low-fee debit card or the like, isn't it?
So the 61% of the card holders at Westpac have no rewards and focus on no fees and low interest rates, and approximately half have a balance which carries over month to month, which tells you that they're using the card to fund essentially week to week, month to month living.
But at the interchange fees they're paying, either directly or that small businesses paying, the consumers are paying, are they effectively covering the cost of the promotional item of these point systems?
Well, just to be clear, there are different interchange rates for different cards. So non-reward cards have lower interchange fees.
But they're not a direct reflection of the actual cost of the transaction, though, are they?
Not on each specific transaction now.
Because some of them are some generalised.
Yeah, so merchants can elect to either pay interchange by interchange technique used, a fee, or pay a simple blended fee. And so that might be the other sort of point to note.
Do we have a breakdown of how the funding of point systems, from the card fees vis-a-vis as taken out of as a proportion of the interchange fees, or is it entirely by interchange, the reward point systems?
So, to the extent that there's cards offered with rewards, those rewards cost to provide to the customer, and interchange fee, potentially scheme fee, potentially fees on the card itself, interest rates on the card, they all go to the, if you will, the revenue generated to pay for the costs of the particular card itself. But I would say that the rewards programs are very specific, very tailored, and very, if you will, targeted in who they go after, and are therefore costed and managed in a very targeted way.
Okay, I could go on with that, but I've got other topics. So there's obviously increased competition in the small and medium business lending. Could you share, and this could be a good news story for you to go with, how you're adjusting your products to expand the offering to businesses in terms of the loans you're offering?
So we've saw good growth in the last 12 months in business, 15%. Saw excellent growth in SME. We saw some growth in small business, which is the first time in a very long time, so we're really pleased with that. The kind of things that we're looking to introduce for business customers is we've improved our working capital facilities. We've launched a invoice financing platform, which is we view as best in market, and we're really excited about its digital straight through and how efficient and available it is for our customers. We've also worked really hard on making sure that for all of our existing customers, we have and will proactively share with them the current appetite and capacity we have to lend them money. And so therefore they have, if you will, in their back pocket, a conditional sort of offer from Westpac to say, look, based on your current financials, we would be willing to lend you X dollars. And so if you need and do want financing, reach out to us. And so it's all part of just trying to make sure that the overall offering into the customer is proactive and importantly, is very targeted to what they need. And so working capital improvement, invoice financing, a subset of that, improving on our trade finance, those are all investments we've undertaken which are allowing us to do more for small business and medium-sized enterprises.
Is it a competitive space at the moment between lenders?
Yes. It has always been a competitive space.
With that, do you think that is to the benefit of small and medium business, or has been for the last few years, that there are more options for them to go find capital?
I think business lending in Australia is very competitive. There's a large number of banks, medium, large, international, domestic. There's a whole host of non-bank financial institutions actively lending into small business, medium-sized enterprises in Australia.
Very good. Switching topics again, how are you working to prepare your existing workforce, whether it's through training, development, redeployment, to be part of a future with artificial intelligence in the bank rather than a victim of it?
That's the work that's underway. We've very focused on immersing as many people into the AI world, so to speak, and hence the idea that we went after having over 15,000 so far of our workforce using the Copilot tool and understanding what it can do and how it can help them day to day. And then there will be layers of incremental investment, layers of incremental work that we need to do to help people use it more. And then as we improve the sophistication of that tool, challenging people to use it more consistently rather than it just being something that they're, if you will, encouraged to look at today. But I think we're a while away from, prescribing you must use this tool X% of the time. But that's certainly, the target, which is, we create an environment where they want to use it and they are using it and they're using it consistently. And it's one of those few, well, like all tools, I suppose, the more you use it, the better you get at it. The better you get at it, the more you use it, and more importantly, you start to think about how you can improve upon it. And that's one of those exciting trends we see in AI, is as people use it, the learn and the improvement is somewhat exponential. And so we're quite invigorated by what that means, and we've just got to make sure we've got the right tools in the right people's hands.
Pleasingly, our people are very excited about using it. We recently held a internal Shark Tank, and we had over 3,600 of our employees participate, developing different ideas for that Shark Tank. We had over 1,200 ideas generated across that cohort of people who've had some exposure to AI, who've taken up the training that we've offered. And many, of course, as you know, are getting that training on their own because they're interested and they're using some of these tools on their personal devices. So people are excited about the opportunity. We think it's really important for our workforce to continue to develop those skills.
Thank you. Member for Brisbane.
Thank you, Chair. Thank you, Mr Zanin, for being here today. I want to start off with scams. I know we've talked a little bit about it, but the National Anti-Scam Centre has estimated there's about $2 billion of losses made in relation to scams, impacting about 500,000 people. Now, not obviously all bank-related necessarily. And the government's spending hundreds of millions of dollars on trying to fight scams. I'm interested to know how much the bank is spending in this space, and I acknowledge that it's probably touches a lot of areas in terms of your operations. And if not an absolute figure, maybe a percentage or your approach to financial security for customers and others.
Thanks for the question. And again, I'll invite Ryan to add his thoughts and reflections. So we are spending a lot of money and allocating a lot of resources. So we have 500 people full-time on scams and fraud prevention and risk management and if you will, mitigation in the bank. So we've got lots of resources dedicated to it. We've spent probably $500 million just investing in technology, analytics capability, surveillance capability, monitoring capability to help us be far better at how we identify and then respond to things that could indicate a scam. We've also introduced a stack of tools such as SafeBlock. So if you're a little bit worried on your app that you may have been scammed, before the money, if you will, truly leaves the system, you just hit like a panic button and it just stops everything. And then, we call you or you call us and we work out, right, what's gone on here? Is there something we need to address? We've also introduced this remarkably simple but elegant solution of just basically SaferPay, which is as a customer wants to send a large amount of money and perhaps is not consistent with its pattern in the past, we ring them and say, are you sure you want to send this? And we go through 5, 6, 7 questions with them. And in putting those questions to customers in the last years, as I said, some $690 million of potential payments were discontinued because the customer said, you know what, upon reflection, I won't. Now, they may well have done it otherwise, but, importantly, it just shows you the activity that we're having to navigate. And then the other one, which we're really pleased with, and you're seeing good take-up, but there's still some way to go, is SafeCall, which is sort of saying, please do not take any phone call from anyone ever in relation to your banking details unless it comes via the app. If it comes via the app, it's us. We absolutely assure you of that, and therefore it's a safe conversation. Far too often we have people impersonating banks, and the sophistication at which they can do that now is quite remarkable. So that's the other sort of levers that we're pulling in how we deal with it. And so last thing I'd say before inviting Ryan to jump in, this is a significant challenge, and it's so important that we continue to be thoughtful about the entire ecosystem needs to be accountable here, because it is a case that we can do as much as we can, but if people are being entreated on a social media platform to buy something and then they're so emotionally drawn into it over a period of time, often people are very upset with us when we call them and say, are you sure you want to do this? In fact, I have lots of problems where my team, our staff at Westpac, are abused by customers who feel, how dare you? Yet it's just driven by the desire to make sure we do the right thing on scams.
Yeah. I would add that we've also developed the confirmation of payee technology for our customers. In addition, we've created BioCatch to understand customers' behavior and to make sure that they are where they purport to be when they go to make payments. But in addition to that, we work very closely with the Fintel Alliance and other authorities to try and stamp out financial crime activity across the network, which feeds back into making Australia safer for all Australians. But all of this is very difficult to do despite the enormous amounts of money that Westpac and other banks have been spending. Really pales compared to the $16 billion that you would see that is revenue that is derived by the social media companies that help advertise and catch customers in this financial crime activity.
Yeah. I understand where you're coming from with that, and it's good to see that they're, how proactive you are. I just wondered too, though, are there high-risk cohorts that you will specifically target to really help them not get caught, or is that part of the broader ecosystem? It's, whose responsibility is that?
So obviously vulnerable customers are always a concern for us. As you note that in many cases the romance scams and investment scams often attract people. When we get the chance to, we intercept and we interfere in transactions to alert customers when we suspect there may be scam activity. And we will, as Anthony and I have both listened to calls at our scam center with customers where our teams on the ground live are interceding with customers to try and make sure that they understand that there are risks associated with scams. And I think, as Anthony mentioned earlier, we think we've saved customers over $360 million in 2025 through that work to interfere to prevent the scam activity from going forward.
One of the important sort of conditions, though, that helps us is we know our customer and we understand and we see patterns in their behaviour, and it's remarkable the instances where more vulnerable customer comes into branch, for example, and says, I'd like to withdraw X amount of dollars, and it's more money than they've ever withdrawn, and the customer service person at the bank can look at that history and realise, gee, you've never pulled that. And then there's a discussion, and you'll find instances that someone at home is taking advantage of them, and or there's some criminal activity which is, and they've become a complicit victim in that particular process. So it's remarkable how understanding our customers and being able to see their behaviours and patterns over time, you can start to identify if perhaps something unusual is happening.
And just still on scams, the scam prevention framework, which is more holistic, and you talked earlier about the ecosystem approach. Are there lessons from other markets that we can sort of take away as you and the industry are developing your codes, or in terms of implementation of the framework?
Yeah, I was just sort of reflecting. I'll certainly ask Ryan to jump in on this one. One lesson we've learnt is that unless you go after it as an ecosystem, then you don't solve the problem. And so in the UK, it was just simply, our bank, you will cover this. And the outcome is that scams and losses continue to grow, and there hasn't been a reduction in scams in the UK. And in fact, 40% of the scams perpetrated on customers, at least in the data we have, come from UK-based scam operators, or at least ones who've been trained and ready and match fit in the context of how you do scams in the UK. And so what we think, Australia is actually the world leader here, and it's full credit to government and regulators and everyone who's embraced this over the last couple of years. We've set ourselves up to be the global benchmark here, provided the entire ecosystem at the same time is committed to those codes and committed to working as one system to solve for it.
We think the most important thing is to make sure that Australia isn't a soft target. We want to drive financial crime out of this economy, and if we make sure that we are not a soft target, those perpetrators will go elsewhere.
Thank you. If I could just change track a little bit on the fees charged to low-income people. I understanding that you're doing your refund to the 148,000 customers, which is, I think, about compensating for what happened. I'm looking forward and saying, how do we protect young people and others who are vulnerable, or what steps are you taking to ensure this doesn't happen again? You said you're moving to put people into the lower fees and opting out. For new customers, for instance, is that going to be a everyday activity? They get the lower fee, they can opt out. Like, how are you going to approach it from a proactive perspective?
I'll make a few observations again. Just jump in, Ryan, as you see fit. We have our product offering that we give to our customers, and what's really important is that we're very transparent about this is what this product does, and this is why you get charged this fee, and you need to be comfortable with that value exchange if you want to enter into this product. So we've got to make sure we get that right. And then certainly what we'd like to do is, if we could, be far more proactive in saying, this is the wrong thing for you, you should use this product. We can't currently do that. And so one of the issues is if we saw someone who has a bank account with us and there's a large sum of money sitting in that bank account earning a low interest rate, we can't say to them, hey, listen, you've got money sitting there for 6 months now, you should really put this into, for example, a term deposit or into this other account and you'll earn a higher interest rate. We can't give that advice because that would be deemed or at risk of being viewed as personal advice. So we'd love to work with you and the rest of the regulatory establishment around how do we find a better balance so that we can be a little bit more proactive, because you're right, what we also see is that a lot of people, we'd like to be talking to them more proactively and saying, don't do this, you should go this direction. We can't really do that. So hence you have that sort of rather blunt approach, which is migrate and then opt out if you would like. Again, that's crude and blunt, and perhaps, we would argue our customers deserve better than that, but that's the current sort of challenge for us.
We might clamp on. Sorry, I'm just being a bit dictatorial as the chair.
Very good. You're doing a good job, Chair.
If you've got one final question, and then we'll go to the 5-minute questions, if that's okay. Sorry, Mrs. Annan, I know this puts at risk my Christmas card allocation, but I might just...
I just wonder how transparent the fees and charges really are to people, because it was discussed earlier this morning too. I mean, how often do people read the terms and conditions, and are there some technological changes that could be implemented with digital prompts and things like that that can make it more in your face for customers?
So I think that's a very fair challenge, and we are very focused on making sure that it's so clear and so in front of the customer as to what they're getting, what it says on the tin is what they get. And so I'd say that that's a challenge ongoing for us. I would say, though, to ensure that we can get to that right state for our customers, just being able to be proactive would be an incremental resource or skill that would just ensure we can do the right thing by our customers. Because sometimes they just won't read necessarily all the detail, or they won't have registered what's gone on, no matter how clear and obvious it is. And it could be second language issues. There could be a whole host of things that get in the way. How do we set ourselves up so we can go further for our customers?
We operate under certain restrictions around the frequency with which we can reach out to customers. And so one of the things that we are looking for is greater ease with which we can reach out to customers for things that we think are in their best interest.
Okay. Thank you. So we'll now just do a quick, I'll go myself and the Deputy Chair, and then back to the member for Brisbane, member for Deakin, member for Moreton, member for Reid. I am going to put on notice just some congratulations on the moratorium. Well done on that, but I am going to put some questions on notice just in terms of the breakdown of your Metro v regional branches, if that's okay. I was a bit concerned about reading yesterday in the Financial Review the story blunt warning to staff to rein in costs. And your Chief Financial Officer, and he's great, he described here that Westpac was staring down the barrel of becoming the most expensively run of its rivals by the end of next year. Probably a bit of creative licence we'd have preferred not be used, but two things. I get concerned, I'm worried who will... If that is the case and you hit that mark, and I understand that you've got a glide path to reduce costs to 2029, I mean, who will shoulder the burden of the cost-cutting regime? Will it be employees, or will it be customers, or will it be both? And the other question I have to ask is, I always get concerned when you hear about cost-cutting having such emphasis about whether or not governance, and again, this is the realm that we're focused on as a committee as it relates to the impact on customers and communities. If you are very focused, sharply focused on cost reduction, sometimes there is a tendency to cut corners or dilute governance. How can you give assurance that that would not be the case in that kind of environment?
Well, thank you for the questions. In terms of the governance, the work over the last 5 years was to set up the infrastructure, the policies, the protocols, the first and second line and third line defence apparatus in the bank, so that pressure to perform or pressure to go in a certain direction is not done in any way, shape or form that compromises the standards we need to meet or puts at risk our ability to meet the standards we need to. And so my Chief Risk Officer, who happens, I think, to be the best one in the market, is a critical sort of part of that, setting that standard where we are challenging ourselves, can we operate more efficiently? But it cannot be at the cost of the standard in which we must operate and the standard we've reached, as acknowledged by APRA's recent removal of or lifting of the enforceable undertaking. So I'll certainly invite Ryan to add his thoughts on that in a moment. In terms of the agenda on costs, the The challenge for Westpac, and it might be slightly more unique for Westpac than others, is that we have a complexity in terms of how the company is currently configured, because the company bought a number of banks many years ago, and as a result we've got duplicate process, duplicate systems, duplicate bank technology stacks in which we operate. And so
So is this why you kicked off Unite?
And Unite is very much focusing on, let's identify all those duplication, let's consolidate it down to one way of doing things on the one technology stack, following one policy, one process. And that will remove quite a lot of cost and clutter in the company, which will help us drive costs where they need to. The second is that, and hence the language you saw from myself and the language from the CFO, is that it's a responsibility for all of us at Westpac, myself as the CEO, absolutely, but for every employee to be thoughtful about how we spend money. And we emphasise, if we're going to spend money, which is our shareholders' money, are we getting value for that? And so things like the services we buy from external technology vendors or the services we provide from external parties, are we paying the right price and are we getting value for that? And to be candid with you, that's a challenge that myself and the rest of the team at Westpac is embracing, which is I think we can do a better job, and hence that language you saw myself use and you saw Nathan use. And then, of course, there's things like management consultants and other external service providers where we just feel that, actually, do we really need that? Is that strictly necessary? You're a good executive. You can, I think, draw the conclusion you need to draw. Do we need to get external affirmation on what you're thinking of doing and how we go about it? And so it's challenging everyone to take some ownership of reducing unnecessary, duplicative and wasteful spend. And so that's the emphasis we're going after, and that's, I wouldn't say low-hanging fruit, but that's the priority for us now, because we've got to get that right. And at that point, I think we'll see a much better cost-income ratio, which is what Nathan was referring to the other day.
Okay. Just some questions quickly on AI. I've already expressed my gratitude for the role of AI chatbots in customer service. But if the interaction that customers have with AI is a chatbot and they have trouble actually getting problem resolution because the way that the loop operates with a chatbot, at what point is the human in the loop brought in to resolve issues? Because you do wonder whether or not it's just an easy way to reduce call centre numbers, human interaction, actual people being involved in problem solving, and just shunting it all to an AI platform. How confident are you that the use of technology will actually make the customer experience enhanced as opposed to frustrating?
Thanks for that challenge or that question. The AI, the generative AI, and particularly the agentic AI, where it does things for you, it's so important that you have, your data in a really good spot, but more importantly...
What do you mean by that?
So the information that it draws upon is safe, secure, and can be relied upon, and there's no mistakes that could be amplified by a model, etc. The second thing is that your process must be optimised. And so in many ways, before we could ever allow a AI augmented chatbot to help deliver a service to the customer, we've got to have a superb process that we already follow. And so that's the challenge that sits in front of us, which is we've got to build and make sure we have excellent processes. And one of the things I'd offer, Chair, is that parts of our offering today, irrespective of AI, are not at the standard they need to be. And I've got to get those working in the right way and have no negative doom feedback loop that drives our customers to rage. It's only when I've got that right, then does the AI tool become a way of helping do that, help our people do that well, help our people get that done safely and to the right standard. And so we've just got work to do about making sure our processes are superb before we start to contemplate how AI could be more involved. What I would say is, though, the experience we have tonight is the tool helps our people do the job to the standard we want to do, and it just helps us get that consistency that we need. And then it's also helping our employees break that negative feedback loop, because they can answer the question and get all of the issues resolved by synthesising all that information using the Gen AI tool to answer the customer's question, as opposed to saying, I'll get someone to call you back, or I'll pass you over to my friends in the next door operations centre. We're hopefully and methodically going to break that down and improve that so we deliver a better outcome for our customers.
Tremendous. I don't want to take up time from my colleagues, so I'll just keep moving along. If we've got surplus minutes, I'll come back with some more AI questions, but over to the Deputy Chair.
Thank you. Do you believe energy prices can be reduced in the next 5 years in Australia?
Okay, I take that back. I'm going back to my questions.
Well, I think there is an opportunity for energy prices to come down. Whether it can be achieved within 5 years depends upon a host of contributing factors. You know, can we get the investment and upgrade that's needed across the grid? Can we introduce the combination of, let's call it renewables, alongside gas peaking, alongside battery storage to ensure that we have what you need to run a very reliable, cost-effective grid? And so the answer is, I think we can get there, but reducing costs, it may not be realistic over 5 years.
Do you think they can be reduced over the next 10 years?
I think there's a time horizon if everyone lines up in terms of what has to be invested in and what has to be delivered, where you could potentially reduce costs.
So the BCA models to get to the 2035 targets, it would cost $530 billion in investment up to that. So who's paying for that? And how are energy prices going down?
Well, that'll be the market, the economy will distribute that cost consistent with the combination of market forces and policy settings.
So that's an extra $530 billion. So assuming someone's recovering that in the market, how are prices going down?
Equally, the alternative is investments needed with the current system we have. And so either way, you've got an investment program that has to be undertaken, and then how does the market redistribute that cost in a way that's fair and equitable?
But you do agree it's additional cost?
I do agree that significant investment
So how are prices going down with additional cost?
I understand the point you're looking to drive at. I just think if we get the investment right, then you can see a future where costs could be lower.
But I don't understand that. If there's $530 billion of additional cost, who is paying for that, and how can prices go down with that? I just don't understand that's possible. Okay. Please, can you explain that economics to me?
Maybe I need to take that back and come back to you with the analytics that we would draw and rely upon in saying that if you get the investment right, we should be able to see power prices cheaper and more cost-effective power.
Because I'd love if you could take that question on notice, and if you can come back to us with analysis showing costs will be cheaper, because from the Nuclear Committee to the Coalition Energy Committee, we would have spoken to 50+ experts.
Yeah.
And you're the first person who said to me power prices will be cheaper.
I'm not a power price expert, so my comments need to be appropriately qualified.
Well, I'm just trying to understand.
And when I say, if you will, cheaper than might otherwise be the case if you don't make that investment.
Because, what I'm trying to understand
is we need to talk about the starting point, the end point, and what are the counterfactuals so we can discuss what we're comparing.
So they may not be cheaper. I'm just trying to understand what you're saying. Are they going to be cheaper, or are they going to be more expensive?
My view is that when I think about the choices we have, continue with, and the ongoing upkeep and investment in what we have today versus the transition plan that people have put forward, that if you execute that transition plan and complete that investment, then you could argue power prices will be better than as compared to the alternative.
So as compared to the alternative, so they may still go up. I'm just trying to understand what you're saying. I'm not trying to put words in your mouth. I'm just trying to be specific and precise in what you're saying.
Okay.
So are you saying they're going to be cheaper, or they may be less than what you think they could be in some other alternate world? They're still going up, but I'm just trying to understand what you're saying and what your comments were earlier. That's all I'm doing. I'm not trying to verbal you.
Okay. And so to try and bring some specificity to it, the outlook is investment is needed either with the current grid and current configuration we have and a significant rebuild and reinvestment in the power generation model that we currently have today, or alternatively, we invest and we go down that transition path or continue to go down that transition path. The longer term cost of and benefits seem superior on that model versus the alternative.
So just to understand that, if you take, let's say Snowy Hydro is going to cost 20 billion. People say it could be 12 to 20. Let's say Orana costs 6. That's 26 billion for 2 projects that are already baked in, and we're still a long way away from targets for 2030 or 2035. 26 billion for two projects. Let's say there's somewhere around 13,000 tax-paying residents.
Yep.
That's an extra $2,000 per tax-paying household. Who's paying that, and how are prices going down? Just for those 2 projects. Now, I'm not even talking about all the other projects all around Australia. Yeah. But there's 2 projects. Now, BCA is talking up to 530 billion. But take those 2 projects. Who's paying for that? It's $2,000 roughly, ballpark. I've just done the numbers on my phone. I might be a little off. Who's paying for that, and how will that lead to cheaper power prices in that example?
You've thrown a set of numbers at me and an example I'll have to take back and I'll do the extra work.
Yeah, okay. I just find that you've said quite confidently, we want to deliver the transition from the transcript. It cannot come at dependability or reliability. It should be such that the power price is not more expensive going forward. I couldn't agree more. Couldn't agree more with your sentiment, but I'm just trying to understand. I would love that to be true, but how you can get there, and just from the evidence you've just given, I'm still struggling to understand how you support that.
Yeah. I'll look to do the work and come back to you and explore with you how we're thinking about that.
But you can't back that up here today.
I think he's indicated he'll come back.
Okay.
Any other questions, mate? You got 6
Am I at time, or have I got?
I think you are out of time.
Yeah, okay, sure.
Yeah, if we've got any spare, I'll come back.
Okay.
Okay, member for Brisbane. If we do this right, we should finish just before. Oh, we've got until 5 at any rate, so I'm probably being a bit too hard on the reins.
My question's around gender pay gap, actually. So the average gender pay gap amongst the Big Four, my understanding, is roughly 24%. What's your gender pay gap across the board, and has it changed over the last 5 years or 10 years?
Our gender pay gap is currently 28.1%, which is
0.1%.
28.1%.
Oh, 28.1%. Okay.
And so, just checking the notes there, that's down 1.2 percentage points in the last 12 months. And so we have a program that we're working towards to narrow that gap further. I suppose I'd sort of advocate that it starts at the top. 50% of my executive team are women, and so we've got the gender balance right. I think the next layer in the organisation, again, we've got that balance where I think it needs to be, and we're also very focused on making sure, and I think we're getting this right, that equal role, there is no gap in compensation. But one of the other challenges for us is the range of roles within the company, and so that tends to, with the part-time or other roles that we have where it does tend to be more women in those roles, that tends to drive a bit more of that gap than should otherwise, than is perhaps occurring at other organisations. But we're on notice, and I'm very focused on how do we get that resolved, and we have a plan over the next 3 years to close that gap.
And at what level is you say the executive is 50-50, where is the discrepancy? Is it all the way through each of the levels, or is it more in sort of...
It's actually a little bit lower in the organisation. So, for example, in roles sitting in our branch network, there are more women than men. The average compensation in the branch work is different to the average of, call it the technology team, where the number of men versus women is quite skewed the other way. And so it's a consequence of that math calculation as to why you see the gap that we have.
And you did say at equal role that there's equal pay at roles now, and that's across the board.
That is absolutely a focus for myself. It is a focus for the team, is to make sure that same role, same compensation. I'd like to think we've got it right in every single part of the company, but I need to acknowledge that maybe an example that we're not, but we are very focused on making sure that is the case across the company.
Yeah, and I'd like to just a quick comment in terms of, you mentioned part-time work, and which makes me think of flexibility.
Yeah.
I think to encourage more women to stay in the workforce, and there's a lot of studies that support this, suggests that greater flexibility is needed. I know Westpac's had a case brought to the Fair Work Commission, but like generally speaking, is that the cultural, is that the overall approach that you're taking to support women who are currently taking on more of the caring role and still home duties?
Yeah, and I think, yes, that's right. Flexibility is really important. And, the flexible part-time 2 days a week or 3 days a week or X hours that you can offer in certain roles does mean more. It lends itself more to women who happen to be, as is the case, the primary caregiver more often than not. And so that drives part of that calculation that you've pointed to in terms of the gender pay gap. What we are looking to do is progressively improve that, reduce that, but at the same time, I don't want to just immediately say, and I could fall into the trap of just solving this by saying, well, I'll just reduce the number of women in branches and immediately solve this challenge. That does not feel like the right response, and that certainly doesn't feel like the right treatment of really important members of our team. What our branch staff do is fantastic for us. And so therefore we've got to work on creating more roles in areas like technology, more roles where more women are involved, and so thus start to address that calculation, or address that gap which you see in that calculation.
Looking forward to seeing the figure go down next year.
It is in my it is part of my scorecard, is the improvement on this over the next few years.
That's good to hear. Thank you.
Okay, Member for Deakin.
I was wondering if you could expand on how investment in the energy transition is influenced by energy policy certainty or lack thereof, and in turn the cost of that transition.
Thanks for the question. I think policy certainty, continuity and consistency are really important if you're going to get investment capital. And so therefore having confidence as to longer term outlook or the longer term policy setting is a really important way to attract the right capital. I think it's the case that also the longer the project takes to build, the longer the project takes to earn its return back, the longer and more consistent setting you need to have to attract the capital to do that.
Would it be fair to say that higher the risk, the higher the cost?
I think any investment proposition where there's higher risk should, in effect, attract a premium. Yeah.
So going to another point on AI, do you think customers should always be explicitly advised when they're interacting with an artificial intelligence system, because they're getting very good at speaking like humans?
Yeah, I think that's a really good question, and one that I suppose we grapple with. What we keep thinking about is, well, it's our job to deliver the service or product that the customer wants, and that it meets the standard and meets what's on the label. And so whether we do that partly through an automated process or partly with an AI tool or frankly any other mechanism, the simple fact is we're accountable for that. And so therefore, does it help, hinder or add value to say, well, in delivering this service to your customer, I'm going to do it these 3 different ways, or I'm going to use these 3 different tools to deliver that service to you? I think that's something to be tested and debated a bit further.
Do you think the customer should be advised? So if I start a phone call, should I be told that I'm talking to an AI, not a real human?
I think that if that's what, I suppose, if that's what the customer wants, and that's what we identify as what the customer wants, then that would be probably one of the ways we should go about it. Because ultimately, the way I've got to deliver my service is where and how the customer wants that service delivered to them. So if they want the service digitally, but they'd like to know that the person on the other side of the phone call, if it's a virtual, is one who's using an AI tool, then if that's what the customer wants, then we'd look at providing that.
But they would need to be told in order to be able to make the choice, wouldn't they?
And we're talking about policy settings and if you will, practice and precedents for the marketplace. It's still formative and early days in the context of AI, and we're making sure that we're using it as a tool that helps our customers do their job, our employees do their job for the customer, as opposed to intermediate our interaction with the customer.
Can you think of any jobs either in decision making or in a customer facing level that should only ever be done by humans, irrespective of how technology develops? Like CEO, for example. No.
People might argue that that's the first job to go. I think it's the case that almost every role. What you could see as the future is that you have an outstanding engineering team, an engineering who code for you. You'd have a small proportion of coders who would be supervising the agentic program, for example, that is set up to write the code that we need to see for a particular investment that's being undertaken. So I keep getting drawn back to this being this tool that helps people be so exceptional or helps people do their job so much faster and better. And so my response to your question is that in some respects it shouldn't replace every single role, but it helps people and helps every single role be better, more consistent, faster, and deliver a better outcome.
Would that not take fewer people by default?
I think that's potentially, as I said, the experience we have is we're able to meet the increase in scam calls and interactions with the bank because this tool has meant our existing resources can accommodate that challenge. So it's helping us minimise the need to add more people, train more people, and in effect, introduce more, into the company.
So if a role is, seen to be one that is likely to be made effectively redundant by AI, does your internal training development go so far as to train them for another role in the organisation that will be required in the future, rather than just relying on redundancies, retrenchments and the like?
So irrespective of AI or any of that, if a role is deemed to be and is made redundant, then we follow a process which includes, is there other roles that we can redeploy you? Is there potentially training that we can employ which will help you get another role inside the company or outside the company? And then we look at, is there other things we can do to help you in that transition? So it's not AI, it's literally that obligation we have, which is if that role no longer is the right role in this company, it is a redundant role, what are the other things we can do for that person, either to redeploy in the company, retrain and redeploy in the company, or provide skills and resources so they can gain opportunities outside the company.
How early is that done? So let's say you've introduced a platform and you think, well, in a year's time, I can see that particular role being redundant. Do you start the training and development early, as soon as you realise that a potential redundancy arises, or after it's already happened?
I think we'd always challenge ourselves, can we start as early as possible? Is it the case that we feel we anticipate things as fast and as early as we should? I don't think we're as comfortable with that as we should be. And so we've just got more work to do to make sure, as we think about the evolution in our workforce, we're thinking about the resources the skills and the training needed to capture what that workforce should look like 1, 2, 3, 5 years ahead. I would say that that's a skill that's we need to continue to invest in the company itself.
Thank you. Okay, so I'm going to go member for Morton, member for Bowman, member for Reid. So over to you.
Thank you, Chair. I was just going to come back to the Fair Work Ombudsman's investigation, the underpayments and back pay. Can you let the committee know how many employees you've been unable to find who are owed back pay?
Do we have that?
No, I don't think to take that on notice.
I'll have to take that on notice in terms of giving you the specific number of employees that we have not been able to trace down to repay. So
Thank you. There's some reporting that suggests it's at the shy of 400, but that there may be about $90,000 that's still owed to them. I was going to ask, and that may have changed, as you've been able to find more people, but I was going to ask, how are you going about attempting to find those people in order to repay them their entitlements?
I would like to take that one on notice in terms of the work plan and the use of external resources to trace people whose addresses have changed, their last names have changed. Mm-hmm. There's a whole host of circumstances that get in between the record we have and the need to go back and pay them directly. And so I just, unless Ryan, there's some specificity you can bring now, we'd have to come back to you on that. But
no, that's fine.
We're very focused on that obligation, legally and morally, we have to find those people and make sure we repay them what was not paid to them when it should have been 5 years ago.
In the enforceable undertaking that you've signed with Fair Work, was there any limitation in terms of time on for how long you have in order to pay those entitlements?
Oh, again, that's an element of detail that I know a little bit of extra work before I come back to you on that. But
No.
We are certainly very conscious of and aware of and sensitive to the fact that we have got to do everything that we reasonably can to get that in the hands of those people who are underpaid.
No, I'd appreciate you coming back to me. And the reason I asked the timing is because if there is a time impediment for former Westpac employees to be able to be paid, then finding them becomes more important.
Yeah. And look, that's a very, very fair challenge and question. I'll just have to go and bottom that out with the team because, that was the Fair Work Ombudsman and Commission was very focused on making sure that there was plans to do whatever we could to get to those people.
Thank you. You've said that the number one, you said earlier that the number one challenge is to build more homes, and you're on the record in media calling for more affordable homes. Can you talk to us about why we need more affordable homes?
The way we think it's appropriate to frame up the challenge is median income in Australia is about $90,000. If you seek a mortgage from the bank, it's anywhere between 5 and 6 times your income, subject to expense verification. That would be the mortgage, and that assumes circa a 10% style deposit. So all of a sudden you've got a mortgage of $450, a deposit of $50. It's a $500,000, 6 times your income. It's $500,000 to $600,000 value of property that sort of solves the affordability for median income earner in Australia. So therefore, how do we get more properties built, if you will, in that price zone to really make it such that the average Australian median income earner gets an opportunity to buy a property? And if I then look at median prices in capital cities for houses, it's over $1 million. So it's very hard in capital cities, albeit I think we need to continue to work at that. Median house prices in regional Australia, and the definition of regional we just need to be a little bit thoughtful about, but the definition and the median house prices there is approximately $650,000. So all of a sudden it starts to suggest, should we be building more houses in regional Australia? But how do we build more houses, more properties in that $600,000 price range to capture? And that could be, we need to do more for thinking about, introduction of modular housing, but also making that more acceptable in the community. How do we build more properties at that price point right across Australia is the challenge that sits in front of us.
No, it's very important, and understand that you've been very passionate about making sure that we build more affordable homes. From 2013 to 2022, we only built 373 of them, and I presume that you would be supportive of needing to build more affordable homes than that in a 9-year period.
I think yes. I think that's a very fair observation. Yeah.
Thank you.
Tremendous. Member for Bowman.
Thank you, Chair.
No problem.
You'd be familiar with what the AFR has written up today in terms of reporting that you've backed away from hard targets on Scope 3 within your climate lending approval framework and replacing it with a more soft ambition for net zero by 2050. Is that an accurate report?
I haven't been pretty busy this morning and then this afternoon. I haven't studied that article, so apologies that I can't sort of critique it. We've slightly adjusted our approach in the space, which is to ensure that we're much more aligned with where perhaps the market and community and our peers are. And so there might be some language they're using saying we've adjusted, but it's just really to make sure that we're consistent with where our customers, where our peer banks and where we think the community wants to go. But I haven't read that article, so I'll have to...
No, that's all right. I can appreciate you've had a busy day. But if you're saying you've adjusted it to reflect where your customers and where your peer group and where your where things are heading, is that not a recognition that achieving net zero by 2050 is all right in theory, but in the real world constraints, it's not achievable?
I think we are committed to net zero and have in place pathways that we're following both as a bank in our day-to-day operations and also with our aspirations around financing our customers on their transition to get to that net zero target. It's not to say it will be easy, and it's not to say that there'll be some customers who are getting there at this point and some customers who are not at the moment. What we want to do is continue to be working with people to help them on that transition. And so the slight adjustment in our language and approach was to sort of give us the opportunity to keep working with people and not step away from supporting them in terms of getting the transition delivered.
So would you say the Scope 3 targets were unworkable?
Scope 3 targets remain the significant challenge for my industry, but also for most of our customers. What we're challenging and ourselves to do and what we're working with our customers on, and all are working to the need to have some ambition around net zero by 2050 in terms of their Scope 3. They need to have some measurement of and some disclosure around what they're doing on Scope 3, and they need to share with us a plan as to how they're looking to deliver on those Scope 3 targets. And so it was that adjustment in and what I've just described then with that language around therefore setting it up such that we can work with people to try and deliver on that goal of net zero by 2050.
All right. But if it's unworkable for your customers, if it's not something that your customers can achieve at this point in time, would you not agree that it may not be achievable across the broader economy?
And certainly we are keen to... We're working with our customers, we're working with the community. We're not looking to leave people behind and we're looking to work with them in terms of going after that goal of net zero by 2050. But I would just acknowledge, yeah, it's hard, and it's going to be harder yet in terms of trying to get there.
What's hard about it?
Well, I think to get to where the target has been set, everyone has to give, everyone has to contribute, and the benefits from giving and contributing won't be realised for a number of years, and most people, and I talk about this generally, struggle with the idea of giving up something now and not seeing a return until their grandchildren or their children have the opportunity to benefit. And so that's a challenge. That's a challenge for everybody. It's a challenge for everyone in the community. And so we just need to acknowledge that. It's not an accusation or a condemnation, but we just need to acknowledge it's hard.
Okay. Just over the short term, what would you say are the biggest risks to the Australian economy? Obviously, we've had a whole range of different data come out in recent weeks. I'd just be, and I'm conscious we're short on time, but what's the, from Westpac across all your books, what would you say would be the major themes we need to be looking out for in 2026 in terms of risk?
I think that's a really great question, and one that sort of just triggers a whole host of observations or worries, and I'm paid to worry about everything, so people should not take that the wrong way. I do think getting the country growing, and I think targeting a growth rate in the area of approximately 3% per annum is the right kind of not less than growth target we should set ourselves, but making sure that growth is much more driven by the private sector investment, private sector activity is, I think, a really important contributor to improving the lifestyle, improving the wealth for all Australians. So, and are we everywhere lined up, and are we everywhere, if you will, putting in place what needs to be put in place to deliver that? I think the answer is probably not. And so I worry about what more and how much more can we get done to just get the country growing at that sort of 3% plus rate, driven by private sector activity, which is why then when I look at... Sorry
to cut you off. Would you say that federal government expenditure and state government expenditure, for that matter, have been crowding out the private sector?
I think the public sector, state and federal, has had to lead the effort on driving growth in Australia over the last 3 years as we sort of came out of the pandemic. And then there's disruptions caused due to geopolitical circumstance, etc., has just meant it's been much harder for the private sector to, if you will, take the lead. But I do take a lot of encouragement from, much more general discourse around growing productivity in Australia, much more focus on what do we do to grow the country, gives me confidence that at least now there's a recognition public sector has done its job, it needs to pull back, and we need to facilitate and allow the private sector to be the lead and the driver of growth going forward. But it's not at a balance that you'd like, and we just need to keep working at it.
Mr Pike, thanks for your questions. We might need to move on. Okay, over to the member for Reid.
Thank you, Chair. And appreciate your honest assessment of the net zero by 2050 target. I just wanted to come back to the point that you raised that 89% of your financing in the electricity market is for renewable energy projects. Wanted to get your insights into why, and I'm assuming this is all private investment in this space, why you think that so many private investors are deciding to choose to invest in renewable energy projects, because these are long-term projects, right? They're not going to see the project come online for some years. Why are they making such long-term plays in the renewable energy space?
Well, I think there's a recognition more broadly, and I know people have strong views and it draws a lot of emotion about transition and the need to transition, and so therefore there's a recognition that renewables is going to be pretty important and its contribution to the transition. The other thing I just want to sort of call out that, in particular, when you think about solar as a source of renewable power, the time to construct is very, very short, and there's not much risk in constructing solar. What you have to have is the grid ready to accept that intermittent power source, and you need to have battery and or other power sources that pick up when obviously that renewable isn't working to the extent you want it to work at. And so therefore, from an investment risk class perspective, in particular solar is very, very manageable. And so you see a lot of, probably call it, investor money such as, super fund and other more passive style investors willing to back those particular initiatives. I think if you're looking at the construction of a, gas peaking or other generation format, a slightly more specialised level of skill and investment capability would be drawn to that rather than necessarily what I just described as super fund. So that's sort of what's, if you will, helping drive and support the investment in renewables in Australia. But it is critical that we recognise two things. The grid has to be invested in to be able to support, and so more work has to be done, much more capital has to be allocated, and, if you will, much more support provided to the transformation of the grid in terms of approval processes and all of that. The second is clearly the battery and or what happens when the renewable's not working exam question. And we do need, for example, more gas peaking capability in the country. We need to recognise gas is so critical to ensuring we get to where we want to get to. And Australia is in a very, very privileged position to have the gas that it has and the renewable resource capability that it has.
There's been a fair bit of discussion around energy prices, and I don't mean to draw on your kind of crystal ball gazing here, but can I paint two alternate scenarios for you? A scenario where there is significant private investment in renewable energy projects with gas as a firming capability there to make sure that energy is consistent and reliable, and the alternative being a turn towards extending the life of our existing coal-fired power plants, or potentially government-funded coal-fired power plants. Of those two scenarios, which do you think where there would be higher energy prices?
That's I appreciate that question. I think the fact that the grid needs to be invested in significantly is a common denominator on both those pathways, and so that needs to be acknowledged. Equally, if you sort of solicited investment capital, in Australia and around the world, and said grid has to be uplifted, improved significantly, no matter which way we go, and of course, here's a renewable in combination with gas as its firming partner, and so I agree with your language there, versus you'll invest in the newest, latest coal power generation capability. I think you'd find the investment capital would be drawn much more to the renewable gas package versus the coal. That's not to say you wouldn't get the capital that you need, but I think the investment capital would be drawn to the scenario of renewable and gas. And the return expectation, if you will, cost of that capital, I would argue, would be probably be slightly more attractive than that capital, which is, if you will, incentivised to go in and support the build-out of the coal power generation. Condition for both is that you have to do a significant amount of investment, no matter where you sit and where you are today, in the grid as we go forward.
I appreciate that. Just one more question. If we could go back to the work around preventing scams. I know that there's been a lot of work done in the anti-money laundering space, particularly around know your customer, and there's certain provisions that banks have to to get that right. Is there an opportunity to use that information, and is this already happening, to use that information to help in preventing some of these mule accounts? Like, is that work happening?
My answer is yes. I think there's been some excellent coordination and cooperation facilitated by the regulators with the banks, and given the big four banks have such a significant market share on those accounts, we can capture a lot of what is going on, and I think we've done an excellent job across the banking industry working with the regulators and sharing patterns and behavioural patterns and other things which highlight, well, actually we should be careful about this, or here's this name and here's this party we need to be conscious of. But I think, Ryan, that's something that is a priority across the banks.
Well, if I can just ask a follow-up, is there any additional information that you would need as part of the Know Your Customer information that you're currently getting that you can't get?
I've got. Did you want to?
Start with, we talk about it as fusion, the intersection between all the elements of financial crime. So you need to know your customer, you need to monitor the transactions, you have to understand what's happening in frauds and scams. You also have to look at what's happening in the cyber crime space. We operate a fusion center that interacts all of those issues. We also interact with regulators and the FinTel Alliance, so that the benefit of all of that information, one informs the other, because it's all financial crime that we are trying to stamp out. It just manifests itself in different ways. Cybercrime attacks the banks and the security of the financial system. Customers who may be bad actors can hijack mule accounts. Money can leave the system and go into crypto exchanges. So it all ends up being an ecosystem. And so all of the elements of our financial crime and technology understanding work to fight those elements together. We do that not only inside Westpac, but we also do it with authorities, including the regulators, and that information is widely shared for the benefit of the system.
Yeah, great.
Okay. Thank you. Just two, as Chair and Deputy Chair, we're going to blatantly exercise or misuse our authority. I was concerned with some material that the Scams Victims Alliance raised with me. I want to ask some really quick questions about. There's a sense that banks adopt a strategy of denying and deferring liability for scam fraud, even where there's clear evidence that red flags were missed by banking staff. Do the banks only reimburse when they prompt victims to sign a secrecy or non-disparagement clause in dealing with scams? And finally, sometimes the losses are so great that it makes adjudication through AFCA very hard. How it would then sort of require victims to go into costly, high-risk legal battles against banks. Do you see the disparity in the power relationship there that might impact on people? Are you able to offer some quick response? And if you want to take stuff on notice, by all means.
But I will respond initially, but also I'd like to come back on that because there are some important themes that you draw out there. If we haven't followed the standard we should follow, we have not applied the policies that we have committed to, then we should be appropriately redressing what the customer has lost. And so we take that very seriously. And so if there are red flags in terms of our behaviour, then we look very much at, well, hang on, what happened? Why did it happen? If that's our fault, then we need to address that. I would say also we don't settle only because someone signs an NDA or a non-disclosure. That's not a practice that's embedded to the extent that someone wants to have a confidentiality arrangement around any particular settlement, then that's always something that's, if you will, negotiated on a instance-by-instance basis. And then I think I would sort of say that building out, and as we're looking to do this scams framework and codification, really making sure that across the ecosystem we've got the right way in which we review and listen to via AFCA complaints and include the entire ecosystem in doing that is, I think, part of the solution to making sure people aren't compelled to go into a court process and incur legal counsel costs and frankly, the drain of trying to position or prove your point.
Thank you. Deputy Chair.
Certainly, if there are instances where there are examples where we have missed red flags and you're aware of them, we would certainly like to know about them so that we could follow them up.
Okay, thank you.
Great. Look, just want to go back to energy because it's critical we get this right for Australia's economy. I think earlier you said solar is quite low risk and that's why it's quite easy to privately finance, something to that effect. Is that correct?
To make sure I've got that specificity right, the construction of solar is viewed as less risky than other power generation construction as a general statement. You know, you put the solar panels up in a vacant area and you connect it to the grid. And
well, I think you're
oversimplified
answering a
it.
question about that's quite easy to privately finance and you privately finance them as a result.
There's a broader range of...
Their risk is lower.
There's a broader range of investors, I think, who can understand the risk of how you build a solar plant and then connect it to the grid. That would be the thrust of what I was saying.
Got it. So look, and why I care about this, Whyalla Steelworks in the last 6 months has gone bankrupt, NiStar's gone bankrupt, Tomago's facing bankruptcy, Bell Bay's facing bankruptcy, Mount Isa Smelter's facing bankruptcy. We've got the CEO of BHP saying power costs are 2 to 3 times higher here than comparable economies. CEO of BlueScope saying energy costs, gas costs are 3 to 4 times higher. So this is a critically important question. So if that's the case, we have a capacity investment mechanism now that's taking taxpayer dollars, so government revenue, and guaranteeing returns for those solar investors. So given the logic you've just used, should we be doing that? Or how do you explain that?
Should we
be guaranteeing the rate of return for solar projects? We underwrite the rate of return so investors can't make a loss.
That's the policy setting that sits here today. I mean, I think provided the renewable program is balanced with the right level of storage and firming capacity, then you'd argue that you don't need to provide any incentive or subsidy because the power demand that we have is so significant and is likely to continue to grow that a well put together package of renewable plus gas peaking plus other firming capacity is going to find a market that wants to buy that power, and so your investment therefore, in my mind, would be a very reasonable and rational investment.
So you'd argue if you took those subsidies away, that would be okay. That would not.
I'm not arguing that. I'm acknowledging that if you get the combination of renewable power and firming capacity right, and the power demand that we have today and will continue to grow, means you've got, in my mind, a really investable opportunity.
Good, thank you.
Thank you. Okay, well, thank you for appearing today. The committee secretariat will run slightly over. I don't think we'll cause offence necessarily with that, but the committee secretariat will contact you in relation to any matters arising from today's hearing. You'll be sent a copy of the transcript of your evidence and we'll have an opportunity to request corrections to any transcription errors. With that, I thank the witnesses and all the members and the secretariat for its time today. I declare the public hearing closed. The committee will meet again at 9:15 a.m. tomorrow here in Committee Room 2R1 for Day 2 of the public hearings with the ANZ and NAB. Thank you, everyone.